Netherlands for violations of PCAOB rules and quality control standards related to exam cheating and misinforming investigators. This case did not take place in a vacuum. Since 2021, the PCAOB has sanctioned 9 firms for exam cheating. I want to be very clear. The PCAOB will not tolerate exam cheating nor any other unethical behavior, period. Impaired ethics erodes trust and threatens the investor confidence our system relies on. The PCAOB will take action to hold firms accountable when they fail to enforce a culture of honesty and integrity. So far this year, the PCAOB has imposed $34 million in penalties, and we've only just begun. We set a record in 2022, we broke that record in 2023, and we've already broken it again just 4 months into 2024. Let this be a clear warning to those who break the rules. If you put investors at risk, there will be consequences. After all, fraud is what spurred the creation of the PCAOB in the first place, and I'm really looking forward to hearing an informative discussion today about fraud. At the end of 2001, Americans were still grappling with the tragic events of September 11th and their aftermath. Our country had entered what would become the longest war in U.S. history, and our economy was just beginning to come out of a recession. Then the Enron scandal broke. Enron's collapse was followed by the failure of its auditor, Arthur Andersen, one of the largest audit firms in the world at the time. And Enron wasn't alone. In 2001, Enron's bankruptcy was the largest in U.S. history. Just a few months later, it was dwarfed by the bankruptcy of WorldCom, yet another corporation caught cooking the books and leaving destruction in the wake of its scandal. And with each new scandal that broke, there were hardworking Americans, retirees, and families who got hurt. Life savings lost, dreams destroyed. Which is why Congress took action to create the PCAOB, with our mission to protect investors and further the public interest in the preparation of informative, accurate, and independent audit reports. Because quality audits protect people, and we must never forget that is why we are here. Thank you again to the SEIAG for your work putting together today's program, and to our outside presenters for joining us. With that, I will turn the meeting back over to Barb to get us started.
Thank you, Chair Williams. I thought we would use the majority of our time today on 2 proposals that were issued since your last meeting and for which the comment period is still open. I do want to mention that in February, the board issued a proposal to update PCAOB rules related to firm registration. That proposal would prohibit a registered public accounting firm and its associated persons from making false or misleading statements concerning the firm's PCAOB registration status, and also under certain circumstances permit the board to treat a firm's failure to file annual reports and to pay annual fees for at least 2 consecutive reporting years as a constructive request to leave to withdraw from registration. The comment period is closed and we received 18 comment letters. I anticipate, and in the interest of time, I won't get into too much detail, but we'll be updating our public agenda sometime in May, so please watch for that. And before I turn it over to the project teams to talk about firm engagement, performance metrics, and firm reporting, I wanted to mention a request from our investor advisory group. As explained at the IG during its April 24th meeting, the IG is seeking nominations from the general public on what people believe is the most decision useful critical audit matters, or as I'll call them CCAMs, or also KCAMs as issued under the IAASB. All timely nominations received will be reviewed and evaluated by the IG. And the IG is looking to select what they believe are the top 3 decision useful CCAMs or KCAMs from 2023 filings among those nominated. Each nomination should include an explanation, which is a maximum of 500 words, of why the nominated CCAM or KCAM provides decision useful information. The IG has requested that the submissions are received by June 30th. We're very excited to see the results of their work. With that, I'll turn it over to Stephanie Hunter of the Office of the Chief Auditor to give a brief overview on our firm and engagement performance metrics proposal.
Thanks, Barb. And good morning to all. On April 9th, the board issued a proposal that would require certain registered public accounting firms to publicly report specified firm and engagement level metrics relating to their audits and their audit practices. And as you know, this proposal has been a long time coming. We drew on input from numerous sources, including the recommendations of the 2008 ACAP committee, the board's 2015 concept release, firm transparency and audit quality reporting, recommendations from the board's advisory groups, and the initiatives of regulators in other jurisdictions. We believe that public reporting of standardized firm and engagement level metrics could create a useful data set to investors and other shareholders for analysis and comparison. Additionally, this information could be beneficial to firms in evaluating their audit practice and related system of quality control. The proposal envisions that reporting would be required in situations where we believe that additional perspective about the auditor and the audit and the auditor would most likely inform investment and proxy voting decisions that investors are called upon to make. Firm level reporting would be required for every firm that audits at least one accelerated filer or large accelerated filer. And engagement level reporting would be required for every audit of an accelerated or large accelerated filer. The firm and engagement level metrics are in 11 areas. Most metrics would be reported at both the firm and engagement level, but for some, reporting will only be at one level. One of the objectives of the proposal is to provide consistency and comparability across firms and engagements. And in order to achieve that, we provided a description of the metric, a specified manner in which to calculate the metric, and an example calculation. We also developed a set of key terms to foster a consistent approach to determining the metrics across firms. Now, instead of providing a bit of details on the 11 metric areas, in the interest of time, I'm going to go through each of those 11 areas and just give you a sense if any of the metrics are going to be reported only at the firm or at the engagement level. So the first metric area is partner and manager involvement, and that will be at both levels. Workload is the second metric area, which will be at both levels. The third is audit resources, and this will be the use of auditor specialists and shared service centers. This will be at both levels, firm and engagement level. Next, the experience of audit personnel, and then industry experience of audit personnel, retention and tenure, and now the audit hours and risk areas metric. This would only be reported at the engagement level. And this would actually report hours spent by senior professionals in aggregate on significant risk, critical accounting policies, and critical accounting estimates. Next would be the allocation of audit hours. That would be at both the firm and engagement level. Following that, the quality performance ratings and compensation metric. That one would only be reported at the firm level. And I will note with the quality performance ratings and compensation metric, the reporting of this metric would not be required for firms that are exempt from partner rotation under the SEC's rules. Next, we have audit firms' internal monitoring. This would be reported at both levels. And finally, restatement history. And that would be at the firm level only, and this would show restatements of financial statements and management reports on ICFR that were audited by the firm over the past 5 years. And so I previously noted the same threshold would apply for both firm level and engagement level reporting. The firm level reporting requirements would apply to approximately 200 firms, and the engagement level reporting requirements would apply to approximately 3,400 issuer audits, representing 99% of the total market capitalization of issuers reporting on Form 10K, 20F, and Form 40F. With this proposal, this should foster comparability across issuer engagements and firms. and provide richer context in evaluating engagement level information, and would avoid potential inefficiency associated with reporting only firm level or only engagement level information. Firms that did not meet the threshold for either required firm level or engagement level reporting would not be required to report, but could choose to report voluntarily. Firms whose client portfolio changes from year to year may be required to report in some years and not others. The draft proposal contemplates that reporting of firm level metrics would be on a new form, Form FM, covering 12 months ended September 30 in each year, and required to be filed with the PCAOB by November 30. The reporting for engagement level metrics would be in a new section of the PCAOB's existing Form AP. The proposal also allows but does not require firms to provide a brief narrative disclosure together with any or all of the firm level and engagement level metrics they report. This would give firms the ability to provide any context they thought necessary for an appropriate understanding of the reported metrics. And the proposal provides that the optional narrative disclosure would be no more than 500 characters per metric. And we look forward to receiving your comments on this proposal by Friday, June 7th. And now I'd like to turn this over to Connor from the Office of General Counsel.
Oh, thank you, Stephanie, and good morning, everybody. I will give a brief overview. I'll try and shorten it up a little bit to get us on schedule of the firm reporting proposal that the board issued on the same day as the FEMS proposal that Stephanie gave you an overview of. And it's just a sort of initial framing matter. The goal here of this proposal is to help enhance public transparency with respect to audit firms, and also to improve the PCAOB's oversight by getting more complete, more standardized, and more timely reporting by audit firms. So this is the overall goal. And really where this fits in with the board's existing framework is to supplement, as you know, Form 2, which is the board's annual reporting form, and Form 3, which is the special events reporting. And so enhancing Forms 2 and 3. I would just note as sort of an initial matter before I give a brief overview of the additional reporting that some of the reporting would be public and some would be confidential. And so in thinking about the proposal and what would be public, what would be non-public, the board thought about the public interest in accessing the information, the extent to which the information would be sensitive, the board's obligations, of course, under Sarbanes-Oxley, and we welcome comments on this balance between public and non-public reporting. Now I'll just walk through the 5 elements of the reporting quickly. First is firm reporting of financial information, and with this one, think of two broad buckets of reporting. And first is enhanced reporting of firm fees, and this would apply to all firms. As you know, Form 2 currently requires firms to report total fees that were billed to issuer clients for certain categories, various categories, as a percentage of total fees, percentage. And what this would do would get rid of percentage reporting and replace it instead with actual dollar amounts, which we think would be more transparent and more useful. The second change in this area would require more complete and further disaggregation of fee information. So a little bit more granular detail on fee information from the firms. The second bucket of reporting would only apply to the largest firms, and the proposal walks through the definition there. And this would be, the largest firms would give the PCAOB their annual financial statements on a confidential, non-public basis. And these financial statements, the firms would report in accordance with the applicable financial reporting framework in the firm's jurisdiction, and would not need to be audited. So that would be really helping the PCAOB with its oversight. So that's the sort of first category of additional reporting. The second one is briefer. It's information about the firm's networks. And so it would require a more detailed, on Form 2, a more detailed public description of any network arrangement that the firm is a part of. And it would include information like the legal and ownership structure of the network, financial obligations, information sharing agreements, etc. So more information about the network. Bucket 3 is enhancements to Form 3, which is special reporting. One proposed change would be to shorten the time frame for special reporting from 30 days down to 14 days, or more promptly as warranted. And there would be a new special reporting obligation for any event or matter that poses a material risk or a material change to the firm's organization, operations, liquidity, or financial resources, or provision of audit services. And one of the things the proposal notes is that some firms provide this sort of information on an ad hoc basis to the PCAOB, and so this would be part of Form 3. And this would be non-public reporting, would be confidential to the PCAOB, and helping with the board's oversight. So that's the third category. The fourth category is cybersecurity, and that is not a surprise. The last time that the Forms 2 and Forms 3 were significantly updated was in 2008, 2009. Cybersecurity, of course, is a much bigger issue than it was in that time period. And so there's sort of two categories of reporting. One is a new special reporting requirement for cybersecurity incidents, and the release defines that. And those would go on Form 3. And again, those would be reported confidentially within 5 business days to the PCAOB, but not public. So those are cybersecurity incidents that the firm experiences. And then the second is a public report with a brief description of the firm's policies and procedures with respect to managing cybersecurity risks. And that would be publicly reported if the firm had such policies and procedures. And we are near the home stretch. The final reporting item relates to the quality control proposal, which Barb mentioned. The board will be considering next week. Currently, applicants for registration provide on Form 1, a narrative description of their quality control policies and procedures. And the board proposed to create a requirement for firms to update these quality control policies and procedures. This is a one-time update if the board were to adopt QC 1000. And so there would be an updated statement that would be done pursuant to the new QC requirements. So that's sort of the high-level summary of the proposal. And we think that, again, this would help the board with its regulatory mission. It would help investors, audit committees, and other stakeholders. And the comment period, again, closes on June 7th. So we encourage written comments and engagement. And thank you. And we welcome your thoughts.
Thank you, Connor and Stephanie. I know we're running at time, but I do want to pause to see if anyone had any comments or questions. Brian?
Thank you very much. Maybe just a couple things on everything that's been covered so far, and maybe something that hasn't in detail. So one, I know on your no-CLAR proposal, I appreciate that you had the round table, and I appreciated the opportunity to participate in that. I know that you received a lot of feedback in comment letters and at the round table on some incredibly complex issues. And I wondered if in kind of advancing that, I know in the past at least there have been some opportunities for this group to dialogue around some of the issues that have been raised, and perhaps even, you may want to bounce ideas of various ways in which you may proceed off of this group. So I wondered if you might comment on whether there's any plans to do anything of that nature, and certainly anything that this group can do. I'm sure we're all pleased to do that. Just on the measures, both at the firm and engagement level, I would submit, and we'll certainly have our comment letter, but I would submit that it may be useful to engage with the firms, of all sizes on this proposal, and really go through each of the measures kind of individually, and maybe a working session even, to understand some of the complexity and differences among the firms, because I do think, we, for instance, provide a lot of transparency in our audit quality report to audit committees and the like, but when you get into how we compute some of our measures, there are reasons we do it certain ways that we think provide good transparency that would be different than probably another firm, just based on their size, their structure, their organizational and other organizational structure and other factors of the way they manage their business, that that while you're trying to get to comparability, I think you actually may end up with something that is less comparable and useful as a result. And so it's incredibly complex. And we've started to go through, and you can spend a couple hours on each one of these and begin to talk about the various issues you might face and differences that you might face, even within our own firm. And then when you start thinking about how it compares to other firms. So I think, if you want to get a head start, I think spending some time in that type of a session would be useful. And then maybe just on the investor advisory group and the CAMs, it'll be interesting to see what you do get there. One of the purposes I thought of CAMs all along has been to potentially even improve disclosure in the areas where matters are CAMs. Obviously, it's to learn about the audit areas that were more sensitive, challenging, subjective, or complex in conducting the audit. Hopefully, we're accomplishing that with CAMs. I don't know that CAMs move markets, and probably, in most cases, probably shouldn't if company disclosure is adequate and appropriate in the areas and there's not some unresolved reporting risk. So it'll be very interesting if there are investors who suggest that they're actually investing based on CAM information and how they're doing that. But I don't think that if they're not, I think there's still value in CAMs, which goes to, again, shining the light on areas of financial reporting that are more sensitive, consistent with probably often companies' critical accounting estimates. So I just suggest that perhaps there are other questions to ask besides whether you're making an investment decision as to whether there's value in current CAM reporting.
Thanks for that, Brian. Thank you for your comments, and thank you for your participation at the roundtable we had on NOCLAR. Happy to take back your thoughts. I mean, at present, we don't have additional outreach planned. We had the roundtable back in March and opened the comment period to allow people to comment on the topics of the roundtable. But again, happy to take that back. Thank you for the comments on metrics. We do look forward to seeing everyone's comment letter, and we'll follow up with comment letters as we see appropriate. Jeff, I don't mean to call you out, but I don't want to speak for you. I mean, I think as I understand, when I see that your request is about decision useful information, it's not necessarily that people are basing investment decisions on that, but rather they find it useful and incremental to the company's disclosure.
That's correct, Barb. It goes beyond investment decision making to include, for example, decision usefulness with respect to proxy voting.
Thank you. John White?
Yeah, when I was listening to Stephanie go through the 11 areas that you were going to be collecting information potentially, a comment from the from an audit committee perspective. I guess I've been a great proponent for audit quality indicators for a long time. Over a decade, we've been talking about it at these meetings without actually going down that direction. But from an audit committee perspective, it seems to me that what audit committees would like are two things: information that will help them in selecting and retaining auditors, but probably more importantly, information that allows them to evaluate what I'll call the audit plan and oversee the auditors and figure out what do they want in their audit. And it's interesting what you're doing is approaching this in a different way. I was assuming the PCAOB was just going to come out with audit quality indicators that would help audit committees in that way. This is collecting or putting into the public domain an enormous amount of information, but for it to be useful for audit committees, somebody's got to digest it and collate it. And I don't know if I'm looking at my academic friends here. You may be salivating at the idea that you're going to get all this information, but somebody need, and I'm not sure whether it's the academic community or frankly, I would have thought it probably actually should be the PCAOB that needs to take this information and help audit committees understand what it is. I'm back to audit quality indicators, but help audit committees understand what it is that will help them get a better audit and oversee a better audit. But anyway, that's my audit committee view.
Thank you, John. Sandy Peters?
Yeah, I raised my card because you said who's going to analyze the data, right? And that's what we teach people to do, right? And I think that I think that there will be analysis of the data. I think that I think one of the challenges in the discussion of the proposal is that everybody wants everything to be perfectly right and perfectly comparable right out of the gate. And we know it won't be, right? As investors, we know it won't be. And as investors, we deal with key performance indicators all day long, and they aren't comparable, right? It's about not only having the metric, but having a respectable explanation of the metric so that investors can understand it, understand the issues at hand, and ask questions. I mean, investors don't get to talk to the auditors, but they do get to talk to management. And it's really about starting, not about perfection, right? Because I think if we seek perfection and perfect comparability, we're not going to have anything, right? And I think over time, that, you know, there will be refinements and there will be things we learn and things we learn are more useful or not useful. But I don't think, it seems as though the reason we've been talking about this for a decade is because it's like, well, we have to find the perfect thing. And we can't do anything until we do the perfect thing. And that's never how life works, right? And so I would encourage us not to get lost in the weeds of it before we say there's truly something here. I mean, I was an audit partner. I know that the number of manager hours and manager and partner engagement was really important, right? As just as one example. So I would be cautious of us saying who's going to analyze the data. Someone will analyze the data and someone will find it useful. I know investors will. Interestingly, I've been doing some outreach for another, as a member of, I'm also a member of the PCAOB. And it's really so much more apparent to me than I always ever thought about how little investors know about the audit, right? And this is just something to help them understand the audit better.
Just understand, saying what I'm suggesting is that you want information for the audit committees. It's kind of an earlier stage than investors trying to influence things later.
No, I get that, and we want that as well. But we also, investors also want to hold the audit committee accountable, right? And I mean, if you look at what investors get to make a decision on the auditor in the US, it's the audit opinion, mostly with CAMs that describe what was done, not what was found, and an audit committee report that explains what was done, but not what was found, right? And so that is pretty much the sum total of what they know about the audit, right? And we're just looking for more information to help this credence good be a little bit more transparent.
Oh, thank you both. Last comment, Dane Mott, and then let's move on.
Sure. Yeah, I just want to, supportive of both of these things, both the CAMIs, I guess, if this make them into an annual award maybe, but today CAMs are very boilerplate and kind of light on content. So I think kind of getting to a place where we can raise them up and have good examples of best practice, maybe that'll kind of drive it. So it is more decision useful for investors. And granted, Brian said, well, are investors making investment decisions off this? Not necessarily, but it's kind of the mosaic theory. You need to look at all types of information. And, today the broad information we have are how much we paid for the audit, the name of the audit partner, and what the audit opinion was. And, and then you have kind of the history, whether there were restatements or internal control issues, but we don't have a lot to kind of work on to kind of get a sense for, as investors, the ones who are ultimately paying for the audit, if we're paying for a good product. So having these starting set of 11 metrics is super helpful. I can assure you there will be data providers, because they're standardized, who will create these into databases that firms will subscribe to, and we'll be looking across this data across firms and being able to do analysis of it, and we'll be able to do compares and contrasts across similar firms and get a sense for, if certain firms are, kind of seem to have a more rigorous audit than others. And it'll lead to better discussions between investors and audit committees and management teams. So thank you for the great work.
Thank you. Let's now turn to our main topic of discussion today, As mentioned, our Emerging Issues and Auditing Subcommittee is going to lead the discussion. Again, thank you for all the work you put into this. Preeti, would you go ahead and get us started?
Sure. Thank you, Barb. Welcome new members to the SEIAG and existing members. My name is Preeti Chowdhury. I'm a full professor at the Dhaliwal Reedy School of Accountancy at the University of Arizona. And I'd like to just briefly mention the other team members that I've been working with. Brian Croto has been representing the auditor's view. David Fabricant has been representing the preparer's view. Dane Mott has been representing the investor perspective, and Jim Hunt is representing the audit committee perspective. We have been working diligently as a group, and what I'm going to present today is a brief summary of what we've been working on related to fraud. I want to emphasize that what I'm summarizing is literally just a summary. That means all ideas that were collected either from us or any of the SEIAG members, some even previous SEIAG members, are incorporated, and we're not necessarily validating these ideas, but providing them holistically to the board to further deliberate on. So with that in mind, I'm going to briefly describe what our process was. For those of you that are new SEIAG members, you may not know, last June we had a meeting where we discussed or brainstormed what top issues, emerging issues, are on the minds of SEIAG members. And one of the top 3 issues was fraud. That came up in that discussion. And subsequent to that, in our November 2023 meeting, we had a group brainstorming discussion on various issues regarding the audit, how we could improve the auditor's fraud detection, and how the PCAOB could improve fraud detection in terms of their operations. As a result of that discussion, we compiled a number of suggestions, and our subcommittee reorganized these suggestions with the help of Brian D'Agato, who I want to also thank, around some of the main standards, PCAOB standards that exist, so that we could further solicit more specific feedback. My understanding is that what the board was hoping to get is a little bit more level of detail than perhaps where we started. So that's the reason we surveyed our members again recently. You may recall receiving a very long survey, and we got 10 responses, which were quite detailed. So I really want to thank those of you anonymously who took the time. And I also want to let those of you that didn't, just to know in the future, we do plan to use surveys to solicit feedback. You can feel free to respond to parts of the survey, or if you do not want to respond to the survey, you can also send comments directly to me or any of the other task force members if you have any comments. It's just a way to allow everyone to participate. So, based upon those responses, we further revised our compilation of suggestions, and I'm going to briefly summarize them in 2 parts. The first part is revisions to audit procedures, guidance or standards, and the second part is programs or policies for the PCAOB to consider in their internal operations. And I also want to note that the completed list was provided as non-public information to each of the members and will be revised one more time based on discussion today before we provide it back to the board. Okay, so issues 1 and 2 regarding discussions between the auditor and the audit committee or management about fraud is insufficient. So most of the 10 responses supported the PCAOB considering guidance or spotlights to enhance these discussions. And some of the specific ideas to enhance these discussions include specifying who and when such discussions should occur, expanding the inquiry beyond the C-suite employees, looking perhaps at what the IAASB revisions were regarding these discussions, enhancing a discussion of disclosure and materiality, inquiring about the audit committee's process over governance of fraud risk, and there were some concerns noted that such dialogues may provide false assurances, so considering what else the auditor should do or how they should interpret these discussions could be helpful. Another issue that came up was auditors may not have sufficient understanding of the auditee's business operations, and that could inhibit fraud detection. Most respondents agree that obtaining a detailed understanding of the business operations is crucial. A number of the specific responses suggested that the staff issue some guidance, such as or similar to the SEC's staff accounting bulletins, that could provide further interpretations of accounting standards, auditing standards with illustrative examples. In addition, there were comments about using the information from inspection reports to issue further staff guidance that would assist auditors in understanding the client's business. And finally, there were some comments about requiring auditors to perform trend analysis across accounts and with competitor company firms, issuer firms. Issue 4, the engagement team may not be sufficiently focused on fraud when doing audit work. How can we improve the team's fraud brainstorming sessions? So general survey responses supported expanding the brainstorming session to include more team members, such as specialists, but including the entire team may just be infeasible. We could consider a spotlight on how to lead such an effective brainstorming discussion, and also encourage collaboration with other regulators and academics to identify root causes and shared lessons learned from such brainstorming sessions. Issue 5, audit manuals used to guide audit execution may not sufficiently address fraud. So some comments suggested consider tying the key performance indicators to the fraud issues. Enhance the requirement to understand what financial information is received by stakeholders to focus on specific areas related to management override. There were some concerns noted that requiring benchmarking may not be cost-effective or scalable for all auditors. And in addition, consider following types of audit guidance, testing journal entries and adjustments for override, how to incorporate unpredictability into audit procedures, and enhanced focused understanding on management's fraud risk assessment. The 6th issue that was raised in this discussion was what additional tools or models we should consider to detect fraud. One suggestion was to create a fraud prevention center to compile research and discovery of fraud. Another suggestion to follow the O'Malley 2000 report recommendations, which include requiring forensic type fieldwork. Third, developing questions designed to invoke professional skepticism. 4th, using data analytics and AI to address fraud. And 5th, that the most common fraud schemes involve revenue recognition, reserve manipulation, and inventory misstatement. It might be useful to consider specific standards in these areas related to fraud risk. Issue 7, whistleblowers are the main way fraud is caught. However, the auditor does not always pay sufficient attention to this area. So we could require auditors to understand the whistleblower process, programs, and procedures to evaluate them and test the hotlines. We could require survey responses indicated that the no-CLAR proposal may have related requirements, so it's important to ensure consistency between the two, and that the auditor could share best practices of having such whistleblower sessions. Issue 8, auditors may detect fraud but ignore the red flags or may not always follow up. There was mixed responses to this issue raised. Many of those survey responses thought that the guidance was clear in AS 2401, that that fraud is a broad legal concept and that auditors can't make legal conclusions. I think perhaps there is some confusion amongst people in interpreting the definitions because of how it's worded, so something to consider following up on. A few respondents did support that additional guidance or use cases could be helpful, especially related to materiality considerations. Issue 9, audit procedures do not have sufficient evaluation of potentially omitted disclosures. Some respondents did not support requiring the auditor to attend disclosure committee meetings, so there was mixed view on whether that would be helpful. Many cited management's responsibility for DCP, ICFR, and including required disclosures in SEC filings. One suggested that there could be independence concerns here with such participation. Respondents also noted that auditors' extensive procedures and tools for documenting compliance with GAAP have extensive checklists. So now I'm going to move on to part 2, which is about suggestions on the changes to the PCAOB operations to address fraud risk. So the first suggestion, which builds on something earlier stated, is to create a fraud center. This could be a repository of fraud schemes and related tests to help auditors identify and act upon red flags that have been identified. Second, this center could compile suggested tools and techniques to identify fraud. They could also compile a list of best practices for whistleblower programs to provide benchmark for auditors to compare against. They could hire forensic experts in the center who can play a role in standard setting or inspection. They could share findings from inspections about fraud detection techniques. And they could also develop a consultation process, not limited to fraud, to advise auditors on best practices in complicated situations. Suggestion 2 was to consider how best to disclose fraud risks and procedures that have been detected. This is a matter I think we're going to be deliberating on later in our breakout sessions, but some initial suggestions are to include perhaps critical audit matters that may require enhanced disclosures regarding fraud, to close the expectations gap related to fraud, in part because of lack of understanding and communication from what the audit is doing. Auditors could disclose that fraud may be detected more clearly in financial statements. The third suggestion is to enhance the PCAOB's whistleblower reporting program. They could do this by using some monetary penalties to compensate whistleblowers via rewards. These monies could be used by whistleblowers to hire lawyers that enable reporting. We note that this would require a change to Sarbanes-Oxley, which currently requires penalties to be used for scholarships. Secondly, to make the reporting on the whistleblower program truly anonymous to reduce the concern of reporting. So the more detailed suggestions were provided to each of you, and I welcome any feedback, either if you have additional suggestions related to these areas or others that were not covered by these. I'm going to allow a few minutes for discussion. And in addition, we are deliberating as a subcommittee on what our next focus area should be. One suggestion we had was perhaps AI, but we are also open to other ideas. So if the SEIAG members have suggestions on other focus areas beyond fraud, we would like to hear that as well. So I'd like to open it up. And again, if you want to put your name tag this way so we can call on you, that would be great. Christine?
I can start off. First of all, I did complete the survey, so
Thank
a lot
you.
of what you talked about did cover my thoughts, but I did just want to say that I think some of those ideas about implementation guidance are very important. We've talked in the past how the average auditor never sees fraud. So if you think about fraud schemes and a fraud center and the library and even best practices for fraud inquiries, making them as open as possible, so tailored to specific facts and circumstances and not generic, to me would be quite helpful. So guidance in that area. You know, the current standard is principles based, and one size doesn't fit all, so I think that does make sense, but clearly there seems to be a need for some type of additional guidance and information to help auditors in executing their responsibilities.
Thank you.
John LeConte.
Thank you.
John.
Over there. I thought it was an excellent summary. Thank you, Preeti. Also filled out the survey, so it's always interesting to see some of your ideas come back at you. Just to follow up on what Christine said, I would go a step further. I think there's a link here that can be made by the PCAOB. If the PCAOB were to create a library of known frauds and case studies of them, and then have them tagged and searchable by industry and cause, and then require them to be consulted by those surveys as part of the risk assessment at the beginning of the audit, it would help in the auditors have never seen fraud. Well, here is a case of inventory fraud. Here is a case that happened in an energy industry, whatever it is. And so I think linking it to the risk scoping at the beginning and making that part of a required audit procedure actually gives a little more power than a standalone voluntary case that's out there. So that would be my additional suggestion.
Thank you.
Steve Morrison.
I want to commend everybody for the survey. I thought that was a great idea, and I did participate, and I actually enjoyed filling it out. Unfortunately, we do have these circumstances that affect entities that are out there, and I think this idea of a fraud center, the information sharing, the knowledge sharing that could go on from that, I think, and I love your idea as well. For a few minutes ago, I think it could be very helpful, not just to auditors, but to preparers and others as well. And I think it will help inform auditors. And I think Christine said something I think that was very appropriate, is that a lot of auditors go a significant part of their career without really seeing fraud. And when you hear fraud, I think a lot of people conjure up images of Enron, something that's on the evening news, but fraud exists on a spectrum. And then it can also be somebody that is stolen a few $1,000s, but then you look and say, oh wait, that person is sitting in a key accounting function, they control disbursements, and it's kind of that figurative pulling the thread on the sweater. And it's also, suddenly you have a ball of yarn that's sitting at your feet, and sometimes you have nothing. Then the guy stole a few $1,000s and he was appropriately removed, or whatever the case may be. But it kind of, we talk in a very principles-based manner, and appropriately so, because frauds unfortunately are evolving, and that while a lot of them that are occurring now, you might see are the same ones you read in your accounting textbooks, there's also some very new and innovative ways that people are doing things. It's kind of a sad commentary as well when you think about that. Wow, if you people put this much initiative and diligence into doing something legitimate, you'd probably be successful. But that opportunity, that pressure, that rationalization that goes into this can drive people to do some interesting things. I was sharing with some people last night that if you think about it, we as a species do terrible things to each other that you'll see on the news, and unfortunately things that we all know occur. That exists on a spectrum as well. So it's not too much to say that if mankind can do certain things to each other, that somebody's not going to steal, somebody's not going to look the other way, that somebody's not going to fudge this particular number because they just need to make this particular bank covenant. And I think as well that I think where a fraud center would go as well is in talking about not just what could happen in terms of this guy did this lady did that, but also in terms of what are the effects on the financial statements. And talking to a number of practitioners, I come across sometimes where people say, don't worry, this all got written off. It's not on the balance sheet. It's like, okay, but does that mean, and that was the example that was in the survey, that you saw an issuer that happened to have a very material unauthorized transactions line item in the financial statements, and that very well may have been useful for users. Perhaps that $2,000, assuming it only was $2,000, it probably is not material enough to go ahead and break out, obviously enough to deal with in the audit and for the preparer to deal with, but challenging auditors to say, to have that right mindset, is this complete on here? And then there may have been a material amount that's no longer on the balance sheet. It's been expensed out, but does that need to be broken out? So kind of going back to what Christine said, that a lot of auditors don't see fraud all the time. I think there could be some help provided, and I know a lot of firms already do this, but it's something that I think that the PCAOB, with its broad visibility into many different firms, to have those information points of what has happened to different entities in different industries and so forth, could be very powerful in terms of that idea generation, or I should say that risk identification of what could go wrong, because it is appropriately principles based, and it's going to need to, in my view, it needs to stay that way. But I think the spotlights, the idea generation that would go into this, I think would be very helpful for auditors, and as well as what you indicated earlier, for issuers and preparers alike, and understanding what could go wrong, which could actually help with prevention. It also could help auditors in terms of audit quality, as well as, unfortunately, the fraud environment keeps evolving.
All right, we have a few cards up, and then we'd like to continue our program because we're kind of running late. And we do have a whole discussion breakout sessions this afternoon where everybody can talk then. So Keisha, and then Sarah, and then Brian, and oh gosh, yeah.
All right, well, good morning. With that preamble, I'm going to be very, very quick with my thoughts. And I just wanted to thank the subcommittee for their work and executing the survey. Well done and well executed. Just wanted to highlight very quickly from the academic perspective, the AAA Auditing Standards Committee in their deliberation of the IAASB's work in fraud and going concern pulled together a response and a commentary. And, you know, the main items that this particular committee pulled together were two of the most promising avenues for helping with this kind of fraud area is the education of stakeholders and possibly revising reporting standards like expanded reporting and critical audit matters. And I'm just going to kind of highlight in terms of education of stakeholders. We talked about the fraud center, but also educating, I think, investors, just to help them understand, you know, what is fraud, and actually what we heard earlier, what is an audit, and what does that entail? Sometimes I think investors may need a little bit of clarity around that, and that's also a key part of the PCAOB in your outreach, and I think that's something that can be executed, you know, with the fraud center. Wonderful ideas there, but also thinking about educating and maybe highlighting what is the typical fraud case profile. We've had, you know, various items happen in our space, and they kind of lend themselves to certain things like large companies, certain CEOs or CFOs having the capability of doing things, you know, really trying to make sure in this education, are we kind of highlighting, because people don't see it in their career, are there kind of typical profiles that they need to be mindful of, or are actually the questions that need to be asked are related to capability, the access, the desire, the intent. We know the words. So those are the things that from the academic community might be helpful. And then also pushing it back. We talk about when they're in practice, but also in our classrooms. I know a lot of us do talk about fraud in ways, but we might be able to broaden that discussion all the way down to what are our textbooks saying. I thought it was funny when Steve said, you know, Enron, yeah, that's still in our textbooks, and most of our students weren't even born when that happened. And so we need to be also inclusive of the discussion down to the education materials that are being in the classroom, and having dialogue with textbook authors and publishers about what is the information that's being provided and what are some real-time updates that might be included. Now that we don't have hard copy textbooks, we have a lot of virtual or electronic materials that can be easily updated, and that's another avenue for outreach. So thank you for the opportunity.
Thank you. And I just wanted to also echo that I thought the survey was very well done, and it was very thought-provoking. And filling it out as an auditor, there were certain things where I'm like, well, that's not what we do, or that's not how it worked. But it made me stop and pause to think that there is this gap. There's this gap in understanding of what actually is happening, how the standards are being implemented, and what people want to be happening in the standards. And I think there's a lot of opportunity for us to work through together. And I know from a with my ASB lens on, we've had the opportunity, Greg Jenkins, one of our academics, has led some fabulous research. And I think Barb said that we talk about fraud a lot. People like to talk about fraud because it's interesting. And this is another area where as we get into what are the performance standards and how do they compare to reporting standards? And it's important to keep those tied together. We don't want to change what we're reporting on and have the expectation gap widen. But this is an area that we've been able to really get a lot of good feedback from preparers and investors because people want to speak about this area. We've been able to share, the ASB has been able to share a lot of research with the PCAOB and OCA, and thank you, for letting us do that, and also with the IAASB. But when I look at the breadth of information that the PCAOB has through the inspection program and the standard setting program, bringing all of that together and then doing more focused outreach, people really want to engage in this area. And so I just think it's a great opportunity. I just appreciate what you're doing.
Thanks. Yeah. Sorry, David.
I'm not going to talk.
Right. I really appreciate those comments in particular because I was a little worried myself as a member that some of the questions or suggestions or what were labeled issues, in some cases, in my view at least, do reflect maybe there's a misunderstanding of what currently auditors do or even where we are relative to compliance with existing standards as a profession. But I think what Sarah just said is really insightful that that information is useful too, because I think there's value for the PCAOB to think about in just even the nature of the issues that people raised, whether there's validity to them or not in some cases. And some of them reflect that perhaps there's a view that in some cases auditors don't want to be responsible or aren't taking their responsibilities serious, and understanding that some people have that perception is important as well. Through the inspections process, obviously the PCAOB has a lot of knowledge as to whether audit manuals are sufficiently updated or whether auditors are considering fraud throughout the audit or whether we sufficiently understand the business. I don't perceive those to be common compliance issues from inspection reporting and from my own knowledge. But having said that, I think there's a lot we can do in this space, and so I'm really excited about the work that's been done by our group. And I would say, from my perspective, at least, I did complete the survey, so pretty soon we're going to figure out who didn't because we've. But there are a few areas in particular. So whistleblower in particular, focusing more on what we can do incrementally around the whistleblower program, and not boiling the ocean, but focusing on things that could matter from a reliable financial reporting perspective. The brainstorming that we do today, there's always room to think about how do you do that differently, enhance it, do it throughout the audit in a more robust way. Inquiries that we're making, I think that's another area relative to being very thoughtful about the nature of the fraud inquiries that we're making, who we're making them of, and the timing in which we're making them. And then I would also say unpredictability, being very strategic and thinking about throughout the audit unpredictability and modifying your unpredictability based on things that you're seeing. All this needs to be risk-based, scalable, because you could spend you could not finish the audit in time if you obviously make it a forensic audit. And so, but I think there's a lot of great ideas here. I think trying to narrow them down to things that could make the most difference from a value proposition perspective and making it most useful for investors in the quality of the audit is what's really important here. So I just wanted to add my perspective on the areas that I thought might be most meaningful, and not for nothing, in the areas I just mentioned, we actually have current pilots going as part of our actions to enhance confidence described in our audit quality report in these particular areas where we're actually in today's audits, on some audits, exploring furthering our work in those areas, and we plan a broader rollout for next year.
Thank you, Brian. I do see a few tent cards up, but in the interest of time, if we can turn to our panels and you'll have a chance to give your marks either in the breakouts or in our session where we all get back together to talk about it. I'm going to hand it over to Brian Degano, who's going to moderate, along with Matt Sickmiller, our panel discussion.
Thank you, Barb. And we'll turn it over to Matt, who's going to moderate the first panel.
All right. Thanks, Brian and Barb. I'm Matt Sickmiller. I'm an assistant chief auditor in our office of the chief auditor. I'm excited to be here this morning to introduce our first panel. Our first panel is going to consist of some prepared presentations that are designed to provide insights from academic research and other investigative accounting disciplines that could be helpful in improving the auditor's work with respect to fraud. So directly to my left, I've got Dan Mahoney, who's the head of industrial sector forensic research at CFRA. And to Dan's left, I have Matt Lombardi, who's a partner at Hemmingmore, specializing in accounting-related forensic and auditing services. And also for our panel, we had Professor Dana Hermanson from Kennesaw State. Unfortunately, Professor Hermanson couldn't be here for some personal matters, but we're fortunate enough to have him do a recorded presentation. So we're going to kick off the panel with that recorded presentation, and then I'll kick it over to Matt and Dan live here in the room, and if we have time, any CI questions. So I believe the PowerPoint slide will be up with the embedded video from Professor Hermanson. Okay, right. What's the chances this is going to work? I don't think we can hear this. Just bear with us for a moment while we get the video audio going.
I know. I was thinking the same thing. Not as much as here.
Sure, Steve. Maybe you guys should just go ahead.
Sorry I couldn't be there face to face, but circumstances prevent that. What I'm going to talk about today is auditors and fraud. Don't forget the people. My main theme is going to be the role of humans and human characteristics in fraud, and how I believe it's important to direct auditors' attention to the human side of fraud. We'll begin with the fundamental question. About 20 years ago, my co-author and forensic accountant David Wolf spoke to my graduate class, and this is one of the questions he asked that day. What's the #1 cause of fraud? And I was proud as my students ran laps around the fraud triangle, gave a variety of responses related to incentive or pressure, opportunity, rationalization, and attitude. But David was looking for something more fundamental. He said the #1 cause of fraud is people, and that's been reflected in the work of several other authors as well. At its heart, fraud is one person lying to another person, or a group of people lying to another group of people. In the case of fraudulent financial reporting, we even know which people are most likely to be implicated. For years, it was the CEO, followed by the CFO. In more recent studies, it's been the CFO, followed by the CEO. But we know who the two people are, and yet it's still difficult to detect because the CEO and the CFO know so much more than anyone else about what's happening in the company. As we think about fraudulent financial reporting, we have a host of different parties involved. We've got everything from shareholders, analysts, regulators, other outsiders. But if you boil it down to the core of the issue, I would maintain that there are 3 key groups to focus on: CEO, the CFO and their team, the audit partner and his or her team, and the audit committee. And it's important to understand what's going on with each of these 3 parties. If we begin with the CEO, the CFO, and the team that works for them, one of the things that's important to recognize is that we get financial information from the management team for a very good reason. Management knows the most about what's going on in the organization. So we have the greatest potential to get the best information by going to management. The problem that we face is that there's an incentive to lie. And that's not saying that managers are evil or that there's anything devious here. It's just a reality that when people provide information that's being used to assess those same people's performance, there's an incentive to make the news as good as possible. Okay? If you ask somebody, how well are you doing at this task, and I'm going to pay you based on what your answer is, there's an incentive to make the news positive. So, frankly, we have an auditing profession in part because of this incentive to lie and the recognition that there could be a positive bias in what management tells us. Second party we have here is the audit partner and his or her team. Certainly a primary role that they fulfill is testing information coming from management, looking for misstatements, whether due to fraud or error. But it's also important to appreciate that the audit partner and the team have a number of different incentives. One of those incentives is to catch misstatements, but there are also incentives related to client acquisition, client retention, okay? Good relationships with the client and the audit committee, getting through inspections properly, avoiding other issues with regulators, including enforcement. So there's a lot going on in terms of the audit partner and the audit team. And there's even research that indicates that if auditors are overly skeptical and yet fail to find a material misstatement, there can be a penalty there as well. So it's important to appreciate that not all of the incentives for the audit partner and the audit team necessarily move in the same direction. There are some competing incentives. At the top here, we have the audit committee. And what research suggests is audit committees range in the degree of substance versus ceremony that they bring to their task. Some audit committees are very involved in providing substantive oversight, directly questioning people, getting into assumptions made and exactly what's going on in terms of financial reporting. Other audit committees are more ceremonial, where they may defer to others to take the lead on these kinds of issues, and they view their role more as hiring the right audit firm, hiring the right head of internal audit, and standing back. Certainly the trend is toward greater substance in the audit committee, but there still is variation in terms of exactly what audit committees do. Down the right side of the slide are a lot of the other things that are going on with respect to financial reporting. We've got controls, systems, numbers, assertions, analytics, AI, standards, regulators, company risk, industry risk, etc. Whole lot of things going on. But I would maintain that the core of the issue is these three parties. And simply stated, if we have fraudulent financial reporting, it's because the CEO, CFO, and team have lied to the audit partner and team and have lied to the audit committee. That's the first stage before it gets outside the company in terms of misstated, fraudulently misstated financial statements. With that background, I think it's important to look at the focus of the current fraud standard that we have today. And this goes all the way back to the work of Donald Cressy in the 1950s, looking at white-collar crime. Essentially what we have is incentive or pressure, opportunity, and rationalization or attitude as the three primary ingredients. It's critical, though, to note what these ingredients are focused on. So incentive or pressure is telling us about the situation in which people find themselves. Okay? Is there incentive due to an acquisition? Is there pressure due to analyst expectations? Is there incentive due to compensation incentives? So it's not really telling you about the people, but it's telling you about the situation in which the people find themselves. Opportunity is about the setting. So there we're looking for weak controls, weak governance, etc. But it relates to the target organization, again, not focused on the people. The third characteristic, rationalization and attitude, is the one that focuses on the people, but rationalization can be difficult for people to deal with. How do you really know what somebody else can rationalize? I think that's why this notion has been expanded to include attitude, so that maybe we can pick up on things about management's view of auditors, management's view of financial reporting, management's view of conservatism that can give us a signal about what they might be able to rationalize. But big picture, what we have is a fraud model that doesn't address people to any great extent. There's nothing in here about skill sets, personality types, anything like that. that would be helpful in orchestrating a fraud. So we've got a gap. I would maintain that we largely have a people problem. Fraudulent financial reporting is people lying to other people, but a standard that largely ignores people. A number of alternatives have been developed in recent years. I'm going to talk about one of them, and I'm going to recognize several others. So please understand, this is not a pitch for the fraud diamond. This is a pitch for people to focus more on people. So Fraud Diamond, a paper I published with David Wolf back in 2004. This was based on David's observations investigating fraud for many years. And what David said is, you've got this notion that the number one cause of fraud is people. He said, I look at the fraud model and there's not much of the person in there, which we just talked about. But he said there's a profile that he kept seeing over and over and over again. There's a certain kind of person with the right skills and makeup to orchestrate a fraud case. He called this capability, and it was made up of 6 elements: position or function, enough formal authority and access in the organization to be able to get things done. Brains, so they've got to be intelligent. Confidence or ego, so the confidence to begin the fraud and to keep it going. Coercion skills may be necessary to get others to support the fraud either knowingly or unknowingly. Effective lying, that's sort of the heart of fraud. And then immunity to stress. So committing fraud, especially for a long period of time where every day brings the potential for discovery, can be very stressful. So dealing with that is a critical element of success. Important to recognize, as I mentioned before, a number of other authors have worked in a similar kind of vein and have highlighted things like the dark triad personality types. So narcissism, Machiavellianism, and psychopathy, also associated with fraud risk. And there is some overlap between capability and the dark triad. That narcissism and confidence and ego are related. Machiavellianism and coercion skills are related. And psychopathy and immunity to stress are related, as it may not be as stressful to commit fraud if you have a less developed conscience. There are other fraud model shapes: the pentagon, the hexagon, the octagon. I'm constantly hearing jokes about how many sides we're going to get to. The octagon may be where the audit partner and the CFO have to fight it out over proposed audit adjustments. But there's been a lot of focus on fraud geometry and exactly how many different elements we can build in to these models. Again, I think the important thing, whatever shape you do, whatever elements you include, is to get more of the person into the discussion. Another thing I'll point out is that capability can be achieved through collusion. So some frauds may require people with different positions, different elements of the company. No one person can do that, so the solution is to form a team. So there can be capability through collusion as well. So this is one alternative with a number of other possibilities out there. Some research evidence about capability and even dark triad. One question that my co-authors had and I had back in 2015 was whether the fraud model matters. In other words, does it matter whether auditors use a fraud diamond practice aid, which directs your attention to capability, or they use a fraud triangle practice aid, which doesn't specifically direct your attention to capability. But we ran an experiment where people were randomly assigned to one of the two groups. Everybody had the same information about the company. But what we found is that those who used the fraud diamond practice aid assessed fraud risk 17% higher than those who used the fraud triangle practice aid. So what we concluded there was, yes, the model matters. It made a difference in fraud risk assessments when auditors were specifically directed to consider capability items. The other thing we found through some additional testing in that paper is that capability and rationalization and attitude move together. Those are really one element. And we call the condensing of the fraud diamond back down to 3 sides. We call that the enhanced fraud triangle. Incentive or pressure, opportunity, and we call the third piece capability, which includes rationalization and attitude. Some other evidence, Albrecht et al., executives' accounting competence, which is an element of capability, interacts with compensation incentives to increase the risk of misstatements. So we normally think of accounting competence as a good thing. There's a risk to it as well. Similar findings from Gull et al. Distressed firm managers with higher ability, i.e. capability, are associated with higher audit fees and a greater risk of restatement. So again, higher ability associated with greater risk. Arrow et al. Find that intelligence and confidence ego are associated with a greater likelihood of fraud. And then finally, Majors finds dark triad personality types are linked to aggressive financial reporting in an experimental setting. So there's evidence out there really conveying two messages. One is that the model matters. Two is that elements of capability appear to be associated with a greater risk of fraud or misstatement. So what do you do about capability? So these 6 points are drawn from my original 2004 paper with David Wolf, as well as a paper that's forthcoming in the CPA Journal, should be out any day now, that's a 20-year retrospective about the diamond, its use, and where we think it may be headed in the future. But we talk about 6 things. Number 1 is explicitly assess capability. So spend time with people, look for signals, assess what others say about a person, try to understand not just the numbers in the company you're auditing, but the people you're auditing. Because at its core, fraudulent financial reporting is person-to-person deception. Number 2, adjust when capability presents high risk. So similar to any other risk of misstatement, we encourage people to adjust their skepticism, adjust their procedures when they're facing high capability that they believe presents additional risk. Third one is continually reassess capability. People change, they gain new skills, and organizations change. So assessing capability is not a one-time exercise, but something that needs to be updated. The fourth one is to consider how capability interacts with other elements. So capability is not sitting over here in its own silo, but highly capable people can create unexpectedly high pressure or incentive on others. Highly capable people might identify opportunities for fraud that most people don't see. And highly capable people could even help others to rationalize fraud in a way that's not expected. So capability can have this interactive effect with other areas of the fraud diamond or enhanced fraud triangle. The fifth one I've alluded to a little bit, and that is to view capability as a double-edged sword. So please don't take from today that capability is a bad thing. Rather, capability is wonderful. We want to have capable people. Capable people can do tremendous things for their organizations, but they also bring risk. So capability brings potential for great good. It also brings enhanced risk of fraud occurring. So you have to recognize both sides of the coin, and capability is a double-edged sword. The last thing we talk about in the 2024 paper is to consider the risks of remote auditing. And here's what I mean. As we think about what's happening in practice now, as I talk to our graduates and others in practice, I'm hearing more and more of what happened during COVID with the tech-enhanced do the audit from home type of approach appears to be persisting to varying degrees in different firms. So it's off-site, heavily tech-enabled. And I think it's important to think about the potential good and the potential bad of this development, which was really jump-started by the pandemic, but is continuing to persist to some degree. Certainly encourage more research on this and encourage the firms and regulators to keep an eye on this. But here's the potential good. So if we see the full build out of data analytics, we see the same thing with artificial intelligence, what that allows the firms to do is test more, find more, and prevent more. And some have argued that this will reduce fraud risk. So if we can use technology to try to get our arms around the fraud problem, okay, reduce the degrees of freedom within which management can move, that is a wonderful development. The other thing that may be striking you, though, at this point in the presentation, is I have talked about people, getting to know people, spending time with people, and that's a bit at odds with what we see in practice right now. This picture to the right here is what I call the jammy pants audit. Okay, that's sitting home in your jammy pants on Zoom or Teams or whatever it is, receiving information from a company, doing the analyses, doing this tech stuff, which is great, but what are you losing if you're not on site? What are you losing if you don't know the people who you're auditing? And what you're losing is the ability to assess capability. Losing the ability to assess personality types. You're also losing the ability to monitor what's going on inside the audit team. So the audit room has disappeared in many cases. So socialization, training, et cetera, within the audit firm is more challenging if we're not sitting around a table doing the audit, but we have a scenario where the staff is in Atlanta, the seniors in Memphis, the managers in Philadelphia, the partners in San Francisco. They've never met each other, and nobody on the team, perhaps except the partner, has ever met the client. It's just a very, very different setting that kind of takes you in a different direction than this focus on people and assessing capability. So where does this bring us? Okay. Research has moved well beyond the traditional fraud triangle, which largely ignores the human element of fraud. So whether you call it capability or arrogance and competence or dark triad, whatever this additional dimension is, and I really encourage PCAOB to consider all of the research that's out there on different human elements. The research has moved way beyond the traditional fraud triangle now. People matter. People are at the core of the fraud issue, and I think it's important to recognize that. As Epstein and Ramamorty state, the fraud triangle is too basic and does not consider abnormal or deviant personalities. And I would add it doesn't consider capability. It is people who commit fraud. Internal controls should not be people neutral, and neither should the auditing profession. So my main message for today is don't forget the people, okay? Whether it's capability, dark triad, etc. All these are important considerations for auditors. I have a number of sources in the last two slides. A few of them have links. Be happy to share any of those with anyone who's interested. And again, greatly appreciate the opportunity to be with you today. Sorry I couldn't be face-to-face, but look forward to reconnecting again at some point. Thank you very much.
All right, thanks to Professor Hermanson for sending that in to us. I'll move it over to Dan. Dan, you can use that to advance your slides. Okay. All right, thank you all for having me here. Just going to quickly talk about, for those that may not be aware, kind of what we do and kind of what our expertise is, just so everybody kind of understands where we're coming from. So CFRA is a forensic accounting and earnings quality research firm. The crux of what we do is looking for aggressive accounting practices that can be used to mask deterioration in a business. We are an independent research firm, meaning we don't run money or anything like that. Our clients are institutional investors, regulators, couple audit firms. So pretty wide array of clients that we work for. But I always kind of say before we do these discussions on fraud and things, we don't exist to find fraud. Somebody mentioned it before, but we really subscribe to the fact that fraud is a continuum. We look for the small things and build on that. And I think any system that starts with "we're going to find fraud today" isn't going to work. And you need to kind of focus on the aggressive accounting, the little things, and build from there. This is a quote. There are a lot of quotes like it. This is from Mary Jo White, but it's essentially the same thing I was just saying, which is just that we tend to when we talk to investors and other clients, there tends to be a well, it's not material attitude, or well, it's just a small thing, and I think that's the exact attitude you do not want to have if you're looking for fraud, because nobody wakes up in the morning and says I'm going to commit fraud today. It's a buildup of generally pressure from somewhere, or a buildup of incentive that starts small and kind of snowballs from there. So when we talk to people about how they can kind of identify these types of things, there's a couple different tools and approaches that we use. Obviously quantitative tools are a big thing. We and I'll get into kind of how we do that. But you obviously want to look at the company's numbers, but you also want to do peer analysis, changes in disclosures, and again, I'll get into all this stuff in a little while. You want to focus on executive turnover, And then market signals like short interest. A lot of times, companies with higher short interest tend to be ones that may have accounting issues. And then one other thing that's big for us that I'll just mention real quick is to monitor. It says here conference calls, press releases, as well as the financials, but basically communications between management and the public or the investment community are extremely, extremely important. You'd be surprised at how often what a CFO or CEO says on an earnings call directly contradicts something that you find in the financial statements. And so I think that's important, not just focusing on whether or not the financials are right, but whether or not there's deceptive practices by a management team. So how can we go about doing this? Obviously, the first step is who do we have working for us to find fraud and aggressive accounting. I think we have hired over the years a lot of people from accounting firms, from different regulatory agencies, things like that. And I will say that the biggest thing, the people that we interview, they're all extremely smart. They all know accounting. The biggest thing is just a basic sort of understanding of the incentives, kind of piggybacking on what Dana said. It's all about understanding incentives. If you interview somebody that's kind of like, well, why would they do that? Or why would they risk getting in trouble to do that? That's not the type of person you want. You want to sort of people that are naturally skeptical and understand how this leads to why people will commit fraud. What are the signals? Things like that. Not just obsessing over whether the accounting is correct and whether the numbers are correct. The other thing that I would say in terms of staffing people to look for fraud is they really have to know a lot about the industry. You need to know what the key metrics are, what the accounting kind of pressure points are, which I think auditors generally understand, but how that kind of translates into what people care about in the industry in the sense of what's going to get managers rewarded. And then the other piece of this that I think is missing when we talk to people who are or interviewing people that are doing audits is we always say, what is the company's story? This is what we talk about a lot. There seems to be often a disconnect between what auditors are focusing on, whether you look at the CAMs or where internal control risks are, and what people actually care about. There are, an endless number of metrics that managers will present to investors. It starts with, the obvious non-GAAP adjustments, but then there's things that are just completely outside the confines of GAAP. Web clicks and all that other kind of stuff. And then you have like-for-like sales for retailers. So, a lot of times we'll look at a company and then you look at the audit report or the financials, and the key audit metric is something around, goodwill impairment. When that is not what anybody is relying on to make an investment decision in the company. And while it may be a significant accounting risk, it's generally not what's going to lead to fraud or a restatement. So kind of continuing on that sort of theme, how do we gain an understanding of what the company's story is and what we should be focusing on? The way we approach it is we always want to start with what's the incentive structure, understanding that fraud is not always for a monetary gain. It is often just I want to please somebody, or I'm scared of getting fired, or something along those lines. You want to understand, obviously, how managers are compensated. You also want to understand where we are in the cycle, not just the overall economic cycle, but the cycle for that particular industry. It wasn't a surprise to anyone that if you think about like Bitcoin and the arrests there started to happen when Bitcoin collapsed. These things tend to, because there's, so if things seem frothy, you really got to have your guard up. Firm performance relative to peers is also extremely important. You want to highlight situations where companies are outperforming and really get into kind of why that may be occurring. And then industry risk assessment. How risky is the industry as a whole? Is it very complex in terms of the accounting? And then does the investment community kind of understand those risks and where those risks might be occurring? Because again, we often see a disconnect between what the investment community is making their decisions on, especially with companies with complex accounting, and what the kind of hairier accounting areas are from a financial statement perspective. All right, so just I'm going to run through these quickly because it's just sort of how we go about the process. I don't think it's a shock to anybody that we would use a lot of quantitative screens to identify companies that may be showing signs of stress, but I think where we differ, I guess, from a traditional investment company or somebody that might be assessing company health is, we're much more focused on balance sheet changes, cash flow changes, the relationship between cash flows and net income. If a company's generating a lot of earnings but no cash flow, we really don't spend a lot of time looking at, pro forma income statements over time and things like that. It's really much more focused on the balance sheet because we find that's kind of where companies will park things if they're trying to overstate earnings. And then obviously the other thing we spend a lot of time on is these provisions or expenses where there are a lot of estimates involved. Again, no major surprises there, but I do think sometimes people forget that some of these sort of standard quantitative screens can really do a lot to identify areas to focus on. This is just sort of an example of how we go about it. We have a number of different variables that we plug into screens where we think. And then again, what I think is important here is, you start with things that you think are important, but again, and this is where industry expertise is very important. You need to know what to focus on, where in a particular industry a manager may want to sort of massage the numbers. And then industry comparisons. There's a couple things here that I think are important. We do a lot of these industry reports where we look at a particular area of accounting for an industry that we think is subject to discretion or a high level of estimation, and we look at it across an industry and try to find the outliers. Now, there's a couple things here. The way we do it, and I think this is another thing that I think especially kind of younger auditors need to understand, is everything needs to be looked at in the context of not just the historical financials, but in terms of what expectations are. I know that's sort of outside of the audit, but it does lead to what the current accounting is. In other words, if you don't understand where management thinks they're going, you're not going to understand what they might do to overstate the results. So in this first example, we look at the remaining performance obligations disclosures, and we look at it not just historically, but we look at it relative to what people think, either managers think or analysts think the company is going to generate in revenue. And so what that'll tell us is that some companies are just way over-promising what they're going to deliver based on what they have in remaining performance obligations. So things like that, and if you look at across industries, you can find a lot of companies that are just over-promising, and then that leads to a greater incentive for fraud. Another key area is just word searches. We've used, when I started, it was really just go go to the SEC website and search filings, but now you have a whole host of tools that you can use for textual analysis that does. Well, what the things that we look for are just changes in disclosures and accounting policies. People need to understand that omissions or removals of disclosure are just as concerning as changes. There are much more advanced tools nowadays where you can literally count the numbers of words in a particular footnote over time, and if those go up or down dramatically, you can dig into that. So these types of tools are getting better and are extremely useful in terms of finding areas to focus on. And then just quickly, what I'll say here, when you do really dive into the accounts, what are we looking for? And just at a high level, just to in the interest of time, I think the biggest thing again here is just looking through the accounts and trying to get in when we're focused on aggressive accounting and fraud, looking for situations that might indicate that the company is being aggressive. So the use of non-GAAP metrics is extremely important. I know everybody uses them, but that's what we love to hear when people say, well, everybody's doing it. But how does that relate to management's incentives? Because that's where you're going to find the fraud. Is the accounting allowed? Is it really the best use representation of the accounting? That's another thing we hear a lot. Well, it's legal. That's always a problem. And then I said this earlier, but when you engage the company, you should always look for public responses or public discussions of similar issues and figuring out whether or not what the company has said in public matches what you see in the footnotes. And so I will stop there.
Great. Thank you.
It's
Great. Great.
You're in control now.
All right. Well, thank you for the opportunity to be here. I really appreciate the opportunity to speak. When Brian and Matt and Kevin reached out to me, the focus was really to provide an overview to the panel of the forensic mindset and how that might inform the discussion that you're having today with respect to an auditor's consideration of fraud. See what you're saying?
Let me get the slides back up, please. Thank you.
There we go. All right. So let me back up. So with that, again, the topics that I'll cover today are really to provide kind of an overview of the mindset of the forensic accountant, some of the relevant practices we use for identifying and considering risk of fraud and indicia of fraud as we get engaged in different fraud projects, and then provide kind of an overview of thoughts where there might be some overlap or some opportunities to apply some of these same measures in the audit. And that's not to say that you turn the financial statement into a forensic audit, but there are some practices that may be informative and worth considering. So with that, let me start with the mindset of a forensic accountant, and please keep in mind that these are general. They're very dependent upon facts and circumstances, but generally when we get called in, there is an expectation of a problem, right? There is already red flags that have been identified. There's heightened risk that we're going into a specific either set of transactions or processes with the mindset that there's potential wrongdoing. Okay, and that obviously differs from the audit concept of you neither assume honesty or dishonesty, right, when applying an audit. The next mindset item that I've listed up here is that management is not the client typically when we get involved. in many times, as has been said, because of the nature of the fraud, is often conducted at the higher level of management. They're not the client. Who's our client? It's typically investors, creditor representatives, people who are not part of the business. Okay, now sometimes the audit committee is our client, but again, it's one level separate from management. The next thing that I've got on this slide, and it's been mentioned, I think by Dan, is the importance of not going to the initial accounting answer. It's easy as an accountant to kind of say, well, what's the technical accounting conclusion? And as a forensic accountant, and I would argue that with respect to an auditor as well, the first step that you want to take is, do I have an appropriate understanding of either the class of transactions or the business process that's being affected? And that is very true with forensic accounting, particularly because one, you've got a wealth of information to understand the full picture, but it ultimately will inform the accounting decision. Okay, and with that comes a recognition that information related to fraud is going to come from a variety of both internal and external sources. Okay, forensic accountants also recognize, just like an auditor, I would suspect does, that there are areas that require specialized knowledge, right? Whether that be legal knowledge, industry knowledge, valuation knowledge. These are things that the forensic accountant's gonna contemplate. And then lastly, I've got on the slide a heightened level of skepticism. What I mean by that is very akin to the auditor's notion of professional skepticism, which is when I'm going through materials, what am I doing? I'm critically assessing the information. I'm maintaining a questioning mindset. Those buzzwords that currently exist in the audit standards are something very much a part of a forensic auditor's mindset, and in some degree has overlap. One item I'm going to focus on that I mentioned earlier was that management is not the client. I bring this up because sometimes I see audit terminology differ, or basically differ from that notion, right? And I remember oftentimes you'll see audit working papers, and up in the corner or over the side is PBC, prepared by client. And I think it's important to remember that, it's really prepared by management. And as an auditor, you've got a responsibility to, test some of the assertions of management. And so that reference to client in the working paper, maybe for a staff auditor, can be, might not send the right message and can be a little confusing. And that I think goes to what Dana kind of mentioned with these competing interests at the auditor level. But I think it's an important concept that if you're auditing, the notion of client satisfaction has that competing interest that ultimately I need to focus on things that corroborate or are inconsistent with what management provides. And certainly as a forensic auditor, the notion of management being a client is not as prevalent. Okay, the next couple slides I think really get to, again, something that Dan had mentioned, which is really the need to understand either a set of transactions or the business or the processes. And with respect to the understanding the transactions, I won't go through it in the interest of times, but I've listed various bullet points of things that you might consider, that we consider as a forensic accountant, to make sure that I've got an understanding of the nature of the transaction. What's the business purpose? Does the size, nature, and timing of the transaction make sense? Do I have an understanding of all of that information? Who's involved? Who are the parties involved in the transaction? Right? These are questions that I'm asking, trying to get information about before I go to, whether or not the criteria of 606 have been met. Right? These are all conditions that have to be determined first. okay? You know, the nature, timing, and size, right? So to give an example, Parmalat, right, where it had sold millions of dollars of powdered milk to Cuba, right? The size of that transaction, and I think it's come out since then, that if you did the math on it, was sufficient to provide everybody on the island of Cuba with 60 gallons of milk. And so, you know, that's something that you want to understand before you even get to, okay, have I satisfied performance obligations? That's an example, right? I've put this next slide in here because it's an area that might not always come up with respect to the processes that accountants look at. And this one is very specific to understanding the business processes that take place. And I'll talk about this a little bit later with the sources of information, but I think it's important to understand that much like what the other two panelists have said is that fraud isn't always this giant red flag. You don't have this red flag. It's a lot of little things. And where Dan was talking about looking at areas where the CFO, the CEO are speaking about things that might be inconsistent in earnings calls, analyst presentations. Well, those same individuals are in the business processes every day. And so to get an understanding of that, you can look to the budgeting and forecasting, and I'll use that as an example, right? Internally, companies are managing to their earnings guidance. And so it's important to kind of understand that and utilize that information in identifying potential fraud. And to give an example, you know, oftentimes companies will set a budget a year before the preceding year, and then over time it'll go from F1, forecast 2, forecast 3. Well, there are meetings that are, of course, happening within those forecast meetings that talk about changes, talk about challenges, talk about opportunities. And just by understanding that process, understanding whether the CFO, the CEO is there, can be very valuable. Okay, so I bring it up in the mindset that, look, focusing on business processes as well as, say, the accounting processes that might fall under ICFR can actually provide a relevant insight into how the company manages its business. Okay. So some of the relevant sources of information, I've broken these next couple slides up into internal and external. Kind of to Dana's point, well, if the majority of fraud is happening at the senior executive level, oftentimes I want to understand, for purposes of scope, if somebody's suspected of fraud, and I'll say it's a CFO in this example, every process that they're involved in, what meetings are they a part of? Can I get those materials? Can I speak with those individuals? And so understanding where these members of the executive committee are on and what they're doing can be helpful. Many companies have risk committees that are already set up, and you know that's their primary task, is identifying risk within the organization. Seeing that can provide additional color into areas that I might want to pursue. And I think, you know, as Dan mentioned earlier, earnings guidance, Q&As, well, there's also an internal process that goes to that. There are prepared notes, right? Understanding, hey, look, can I get those prepared remarks? Because some of them are prepared in anticipation of questions that are never answered. That can be informative, right? I think some of these others, I'll skip down to the bottom, but whistleblower tips, just given what has been said, and I think the Association of Certified Fraud Examiners came out with their recent report, which affirmed that the majority of fraud is detected through whistleblowers. right? Understanding that process, speaking to counsel, understanding the submissions, it can provide a valuable resource of information. External sources, I won't go through some of that, as I think Dan did a good job of doing that, but certainly short sellers. There's organizations out there like analysts, like Dan's group, that are identifying these risks. So does it make sense for a financial statement auditor to look at that, just like it would be a forensic auditor if I'm investigating a specific issue? Absolutely, right? In the sense that it may provide additional color. Oftentimes we'll be engaged due to suspected the short seller reporting, right? And that will trigger a forensic accounting analysis. Skip ahead, so with that background, where are areas where a forensic practice might help inform kind of an auditor's consideration of fraud, recognizing that an audit, financial statement audit, is not a forensic audit. But again, there could be value in some of the processes that we undertake. One, again, expanding audit procedures to understand key business processes, right? Not the order to cash, not the procure to pay process, but the business process, that forecast process, that earnings call process, right? Those types of things provide an understanding of the business that you might not otherwise get if you're just looking at the sales and revenue rec process. Okay, develop specific procedures to identify inconsistencies. This gets to a comment that was made earlier that oftentimes, again, fraud is not, it's detected through little inconsistencies, little contradictions in representation. As Dan's saying, well, maybe you've got an external presentation being given to an investor group where the CEO says one thing, and that's consistent. That's entirely inconsistent what you're being told as a financial statement auditor, right? So developing procedures related to that. I'll go over a few in a little bit. Expanding use of forensic industry, data analytic, legal specialists. There are events like the fraud brainstorming session, and I've seen, the auditors today will often engage forensic accountant to kind of help that process, and I think that's a great practice. Regulated entities that require specific legal understanding that an auditor isn't necessarily gonna know. That may be useful in situations where there is an ongoing inquiry or an investigation, right? How do we respond? We're accountants, we're not attorneys, so maybe it makes sense to bring in that outside legal expertise. Industry, construction specialist, depending upon what it is, right? Incorporate professional skepticism into the work steps. I'll go over what I mean by that in a little bit. But the last point there is expand types of external confirmations. This really gets at needing to understand the transaction or set of transactions, right? And I think there's in the audit standards right now, or or recommendations to consider whether to confirm sales terms and conditions, things of that nature. That may be very appropriate for significant, unusual sales transactions, right? Also, just considering legal inquiries. Again, if I've got a company that is being investigated, or there's concerns about regulatory compliance, that's outside of my area, but I realize it could have an accounting implication. maybe to make sure that I've got the complete information, I'm expanding the nature of the questions that I'm asking to outside counsel. It goes for whistleblower tips as well, right? Expanding that. Well, external counsel is typically involved, right? Let's, maybe expanding that concept. Talked about expanding for business, expanding understanding of business processes. But the one thing I'll point before I move on to the next slide is something that Dana had kind of said is the importance of face-to-face interaction, right? And I realize COVID has, and technology, frankly, has shifted a lot of the way that audits are performed. Certainly back when I did audits, there wasn't a lot of that technology. But again, just like it was emphasized back then, and I think today is no different, being able to conduct face-to-face, inquiries really can provide some valuable feedback, just in the way it does for forensic accountants when we're actually conducting interviews and we're looking for inconsistencies and, frankly, indicated pressures or concerns that are raised to us. The point that's on the slide also gets it. Well, instead of having those face-to-face interactions with the revenue manager, maybe it's going to FP&A, right? And understanding that process of F1 to F2, right? And I'll give you an example with just that, and I realize it's not getting into the interviews, but there was an instance when I got a presentation and they were trying to meet essentially the forecast one, and they, the way this company broke it out is they'd have opportunities and risks, and then they'd have a waterfall schedule that would essentially show how they're going to go from where they're at the current point to where they were. And when you looked at the presentation, there was all these customers that they had listed, and then there was this one entry, Project Alpha, right? And it was just the name of it stuck out, right? And you kind of scratch your head, well, what is Project Alpha? And it, irrespective of whether it was fraud, if a financial statement auditor gets that, right, applying, a questioning mindset, it might lead you to the next question. What is this about? And so business processes can be important. I know the topic of fraud brainstorming has come up. Oftentimes I see it done at the planning stages, right, which is great, but because fraud is identified in small increments through inconsistencies and contradictory information, there's a benefit to having gone through interim procedures, year-end procedures, and having that same fraud brainstorming discussion at or near the end of an audit, right? Asking some of the questions that are in there to staff, not only to certainly to identify whether there's inconsistencies, but to reiterate and get in the mindset that this is still an area of focus, right? It happens throughout the audit. So I see a benefit to having something similar to that towards the end of an audit, right? When you know more information, when you've seen that significant unusual transaction. Okay. Review transaction correspondence. One of the internal sources of information I get, and I failed to mention it, but it's on the slide, are obviously the wealth of emails, right, that might go into the negotiation of a transaction to help me understand the nature of the transaction, the relationships involved. To the extent that you have a significant unusual transaction where you need to understand the business rationale, communications between those involved in the negotiation process can provide that that relevant and important information. Targeted use of forensic industry specialists I spoke about. The other bullet point of incorporating professional skepticism into the work steps. You know, again, and I'll use sales as an example because it's where we typically see a fair amount of fraud to get to specific earnings targets and whatnot. But when you have an audit work step or procedure that says, make sure that the, performance obligations have been satisfied, right? Consider work steps that encourage the staff to critically assess. Use that exact language. It's from the standard, right, as a reminder. Identify inconsistencies between information from here to there, right? So maybe setting up work steps with that in mind, right? So that it's, yes, the accounting answer is important, but I've also got this in the back of my head that I need to focus on inconsistencies, or I need to make sure that really my threshold is critically assessing or questioning something. Right? So that's it. At least as far as my prepared remarks, I'm happy to answer any questions as need be.
Yeah, thanks, Matt and Dan. Dude, I'm not sure. Do we have time for a Q&A? Okay.
I think in the interest of time, I think we'll just go to a break right now. But if there are any questions, let us know, and we'll have a lot of other opportunities for SEIAG members to give their thoughts and considerations on the panel as the day goes on, in particular during the breakout sessions. So I think we'll regroup at 11:30. Thank you.
10-minute break.
Thank you.
Thanks.
And so I was like, I could wear these ugly things and get by rather than like.
I don't know. I'm gonna scope out and see. I'll see. I'll see what I'm
Go, and then I'm gonna take notes and I'll follow you.
I wanted this over here and somebody texted me. Okay, we're not getting through there. So I came over.
I think it was like the odds of me and two people.
I know, well, that makes you,
Yeah,
and we that way don't have safety concerns.
I think that's
Oh, yeah.
people are sitting there at some point.
And that's the whole, like when Keisha said, do people understand what this is? I mean, she's absolutely right. We are auditors, and we don't train our students that are auditor classes. There's materiality.
Absolutely.
Is it gonna affect the financial statement?
Yeah.
That's what, every single fraud, but yeah.
No, and that's part of the system, so we're trying to capture. One, and or you should be doing forensic there.
No, that is not applicable.
Yeah.
It's absolutely not applicable.
Well, good, I guess,
I'm nice, but yeah, it is chillier on this little town.
I know. I'll be very quick. Okay, sure.
Other pieces of the
I said I'll go last week. Yeah, I was gonna go.
Yeah, she said you were sick or something.
Yeah, I got all these. Post it, you would. Everyone, I hear both ways, so it doesn't really faze me. Of course, no, happy to do it. Okay.
Glad to hear it. Thanks for listening.
Yeah, I call it what is on.
Okay, great. Is there somewhere that have like coffee and water? Is that what they're down there? Okay. Perfect. Thank you.
I hope so too, but I'm not convinced. A bunch of
Already,
I'll
right?
make some comment when we get to it about how
My
this
chair.
relates to.
What a committee.
Thank you for the same comment. Same thing, I'm going here.
I know.
I mean,
Well, a lot of stuff was covered, which is good. So I think we're done. So I think that's good.
Yeah.
Yes, it is. Yes, so there's a recording.
All right, everyone can get back to their seats. We'll start the second panel. Who is a part
And I think it's important to look at them mainly to see why things didn't work, what did work, how, and as Brian said, how we got to where we are. One of the things you would notice if you went carefully over this history is that it shows there is life after death. Things that were said in the original standards have continued to be in the mindsets of auditors and others well after they were removed from the standards. So the first standard was in effect from 1960 to 1976, very long period of time. And it really denied all responsibility for what were called defalcations and similar irregularities, now called misappropriation of assets. The phrase used was the audit was not specifically designed to detect and cannot be relied on to disclose. And those very words carried over, that's in the mindsets of auditors well after they came out of the standard. It did recognize that deliberate misrepresentations by management were closer to the auditor's objective, but it was in there very subtly. One of the key things is the detection responsibility was only for failure to detect fraud that arose only when that failure resulted from a failure to comply with the auditing standards. But the auditing standards didn't say anything about how you would go about detecting fraud, so that wasn't very helpful. There were a series of major frauds National Student Marketing, Penn Central, Continental Vending, well-known names. But the big one that came along in 1974 was equity funding. Equity funding was both an insurance company and a broker-dealer, highly regulated industry. The chairman of the SEC summoned all people involved, including standard setters, to DC, said, how did this happen? What are you going to do to make sure it never happens again? And the result was what's called SAS number 16. It mentioned an attitude of professional skepticism, overriding internal controls. All those things were there at that time. Whether management might be predisposed to misstate the financial statements. But then in the mindset, it said, assume management's honest unless there's evidence to the contrary. So that aspect of mindset is very important. Coverage with both errors and irregularities, but the responsibility for them was in terms of to search for errors or irregularities that would have a material effect on the financial statements. In other words, not guaranteeing detection, but clearly trying to trying to detect. That standard was in effect about 10 years, 1977 to 1987. It brought into the literature the notion of inherent limitations of the audit. Forgery, collusion, falsification of documents, unrecorded transactions, management's ability to override controls, all things that are legitimate limitations, but putting them in to the extent they were and the implications for mindset effectively meant it was telling auditors, well, maybe you could try to detect fraud, but you're not going to be very good at it. You're not going to be able to do it because of all these limitations on your audit. So one thing that could be done in the standards is eliminate completely the notion of inherent limitations on the audit. It holds auditors back. It never has been very convincing to users. There have been attempts over the years. People have said, well, we need to educate the users on our responsibility as auditors. That's never worked. The Cohen Commission has said it's the auditor's job. It's not the users that need to be educated. Auditors need to step up more to the responsibilities. But SAS 53 didn't work. Even though it said design the audit to provide reasonable assurance of detecting errors and irregularities material to the financial statements based on the assessment of risk. And with slight variations in wording, that's the standard of responsibility up to today. And the big question is, why hasn't it worked? Why hasn't it worked? Auditors do emphasize that the responsibility is related to misstatements caused by fraud or irregularities, whether they are due to fraud or due to error. But what that may tell auditors is you don't specifically focus on trying to detect fraud. You try to detect misstatements, whether that cause is error or fraud. But that, as we will see in the final auditing standard, was found to not work. And there was an attempt to be made to put that in what might be called the dustbin of history. SAS 82 came next from 1997 to 2001. It really had the same notion. It emphasized misstatements. It changed the language for some reason to obtain reasonable assurance rather than provide reasonable assurance. Linguistically, that's a bit difficult to understand. If the auditor obtains it, they ought to be able to provide it. So I would say let's go back to providing reasonable assurance. There were a number of significant frauds in that area. But the main thing that caused SAS 82 to be issued was the POB at the time telling the auditing standard setters that based on peer review results, it was clear that SAS 53 had not taken hold. Then, a significant development outside of the standard setting was a letter by Lynn Turner in 1998 that questioned whether auditors had shifted too much to analytical procedures and reliance on controls, needed to do more substantive testing, created the panel on audit effectiveness, and that's where the recommendation came in for forensic type procedures, not a forensic audit. There is in fact no such thing as a fraud audit. Nobody does a fraud audit, not even fraud examiners. But the notion was more forensic type procedures. The panel on audit effectiveness basically concluded that SAS 82 was a total failure as far as improving the auditor's ability at detecting fraud, that it didn't increase in any way the auditor's ability to detect fraud, and that resulted primarily from a lack of a direct focus on detection of fraud. In other words, misstatements, whether error or fraud, rather than audit work directed directly to fraud and directly to misstatements. The panel on audit effectiveness made a number of recommendations, and most of them were put directly into the auditing standards. That's where the brainstorming session came in. That's where the procedures on predictability came in. That's where interviewing more people came in. So one thing to do in improving the auditing standard would be to go back to the panel on audit effectiveness recommendations. The change in mindset was there. Originally, it went from assume management's honest to what was called neutrality, assume neither honesty or dishonesty. Neutrality with the standard, which was SAS 99, which is the current AS 2401, abandoned neutrality. It does not say the auditor should be neutral. It makes very specific statements about being aware that management could be committing fraud, not to accept less than persuasive evidence because of a belief that management has integrity. So that notion that you should take a neutral stance, which basically failed because auditors essentially concluded if the client is a client of our firm, we've already concluded it has integrity. So we don't have to worry about that. Obviously, if the management lacked integrity, they wouldn't be a client of the firm. So neutrality never worked. But the notion of assuming that management is acting dishonestly in the forensic type part of the audit that was recommended by the panel was adopted as part of the brainstorming session. Try to figure out how management could perpetrate a fraud. Try to figure out how they could deceive us. That basically hasn't worked because of one of the other major things that the panel noted in all the focus groups they did with auditors was to say that auditors are uncertain about what their responsibilities actually are, and they have doubts that they can meet those responsibilities to detect fraud. And dealing with that and dealing with that mindset is, to me, the most basic problem in developing an effective auditing standard and improving audit quality in the area of fraud detection. They also recommended forensic type procedures during field work and during interim reviews. And that aspect has only half-heartedly been incorporated in the standards. That brings us up to today. If anyone has questions on the history later, I'd be glad to answer them.
Any questions? Thank you, Doug. And maybe let's turn to Davis. And Davis, can you give us some insights about what regulators might expect from auditors with respect to fraud? And for example, we often hear terms like the gatekeeper, red flags, heightened scrutiny. How do you see these concepts?
Thank you, Brian. The federal securities laws, to a significant extent, make independent auditors gatekeepers to the public securities markets. These laws require or permit the SEC to require that financial information be certified, that is, audited, by independent public accountants. The auditor is the only professional that the company must engage before making a public securities offering, and the only professional charged with the duty to act and report independently from management. SEC staff have expressed the view that a critical part of the auditor's responsibility in their role is with respect to fraud detection. Under PCAOB auditing standards, auditors have a responsibility to plan and perform the audit to obtain reasonable assurance about whether financial statements are free of material misstatement, whether that is caused by error or fraud. And the unqualified auditor's report language reiterates this responsibility. Regulators expect auditors in their risk assessments to appropriately consider fraud. When confronted with information raising the risk of material misstatement from fraud, subjected to heightened scrutiny in its evaluation and resolution, and that this be documented. In exercise of these responsibilities, auditors should perform their risk assessment procedures to provide a reasonable basis for identifying and assessing the risk of material misstatement from error or fraud, and then to design tests to address the associated risks. Included in these risk assessment procedures is a discussion that Doug made reference to among key engagement members about the potential for material misstatement due to fraud, often called the fraud brainstorming session, in which participants should have a questioning mind attitude, and set aside their prior belief that management is honest and has integrity. Risk assessment should continue throughout the audit. When an auditor obtains audit evidence contradicting that used as the basis for their original risk assessment, the auditor should revise that risk assessment and modify its tests and perform additional tests in response to those revised risks. PCAOB standards also include certain fraud risk considerations or presumptions that require a response from the auditor, such as the presumption of fraud risk concerning improper revenue recognition and the consideration of the risk of management override of controls. Heightened scrutiny is a concept of increased attention by an auditor applied to certain matters that are important or material when warning signs or other factors alert an auditor to heightened risk, or as set forth in the applicable standards. For example, the need for heightened risk of related party transactions has been highlighted by SEC enforcement actions and was considered in developing the board's 2014 changes to its related party standard. Identifying and responding to the risks of fraud is another area where heightened scrutiny by auditors may be applicable. An auditor should design and perform procedures that are specifically responsive to the assessed fraud risks. Increased attention is needed to specifically address the risk of management override of controls. For example, heightened scrutiny is applicable to the identification and evaluation of significant unusual transactions as a part of the required procedures to specifically address that risk. Red flags, also called indicia or indicators of fraud, represent information, i.e. audit evidence, whether obtained by the auditor from their procedures or other sources that appears to be suspicious or implausible, imprecise, or inconsistent with, contradictory to, management's assertions that its financial statements are 1, free of material misstatements due to fraud, and 2, that its ICFR, that is internal control over financial reporting, will, among other things, initiate, record, process, and report transactions, events, and conditions consistent with those assertions. When an auditor is presented with inconsistent or contradictory audit evidence, or they have doubts about the reliability of the information it's using as audit evidence, the auditor should perform procedures necessary to resolve the matter and determine what effect, if any, it has on other aspects of the audit. And of course, all this needs to be done with the requisite due care and professional skepticism that's required throughout the audit.
Thank you, Davis. Laura, could you give us your views as to what investors expect of the auditor with respect to fraud, and do investors look to the auditor as a gatekeeper?
Thank you. So I think as a general matter, not only investors, but all market participants as a whole believe that auditors serve in a gatekeeping capacity. Not only is it set forth, cannot hear me? Can you hear me now? Okay. Not only is that set forth in the statements by the various regulatory bodies, whether that's the SEC or the PCAOB, but I think it's widely recognized by the accounting industry itself. When I was preparing for today, I was taking a look at some recent statements by the Big Four auditing firm, and I came across a statement by KPMG's chief auditor just last year at a conference. In which he said that maintaining trust in the audit profession is essential to meeting investor expectations. Audit firm integrity is the foundation for high quality audits and supports investor confidence in the capital markets. And I think that is largely how investors operate. They believe, based on the manner in which we have described the function and the responsibilities of the auditing profession, that they are serving in this independent gatekeeping capacity. They believe that if they have audited financials that are signed off on by a credible auditing firm, that those financials are truthful and that they disclose all material information that they need in electing whether to invest in a given company. You see that also in analyst conference calls in which either, excuse me, investment advisors or investors themselves are questioning companies, not only asking when a company is kind of moving up from the penny stock world to more larger market cap, to hire better auditors, to hire Big Four auditors, but also asking specific questions about that process. Asking specific questions about how the financial statements reflect the reality of the situation, and chief among those questions is whether the auditor has done its job. So I don't think there's any question that they see the role of the auditor as a gatekeeper and that it's a critical role for them in electing whether to invest in a given company. Whether that belief is reflected in reality, I think, is where the rubber hits the road. I think perhaps what investors think is happening is perhaps consistent with the rulemaking, but not necessarily consistent with practice. And that, I think, is really kind of the critical question today is, or maybe for the future for the PCAOB to consider, is whether the rules need to be modified or enforcement needs to be more robust, such that the expectation by investors and the expectation of the rules are actually fulfilled as investors expect them to be.
Thank you, Laura. And maybe now if we could turn to Christine. Christine, could you give us your views on the auditor's responsibilities regarding fraud, and maybe also your thoughts on how the auditor's responsibilities differ from management and audit committees?
Sure. Thank you for the question. And Davis did a great job of kind of going over the auditor's responsibilities. So I'll try not to be redundant of that and just give my perspective on that. And I do want to focus my remarks on the auditor's responsibility since we have a critical role. But of course, there is other main parties responsible. Management and the audit committee clearly are the main line of defense when we think about detection and prevention of fraud, and management is responsible for designing and implementing and maintaining the internal controls that in fact prevent and deter the fraud, and then the audit committee has oversight responsibility over that and over fraud prevention and detection. And the audit committee and management are responsible for the investigation and initiating that investigation and then taking appropriate remedial actions if remedial actions are determined to be necessary as a result of their investigation. We've heard several times today that the auditor plans and performs the audit to obtain, not provide, as you said, but to obtain a reasonable assurance that the financial statements are free of material misstatement, whether that's from error or from fraud. And the foundation of our audit is professional skepticism. So we've talked about professional skepticism a few times today. There was the discussion about I think in the last panel about even expanding our procedures. Well, every procedure we do, the cornerstone of that is professional skepticism, and we do critically assess that every time we're doing our procedures and making sure that we are thinking about that. And we do that, by the way, regardless of our past experience with the company and regardless of our belief about their integrity or the ethics and honesty of management. And we do perform extensive and iterative risk assessment process and procedures, and that's really the cornerstone of the audit, is that robust, iterative risk assessment process, which does get updated and changed throughout the audit, depending on the facts and circumstances that exist. And the focal point of our risk assessment process is understanding the company and understanding their business. A prior panel also talked about that and perhaps indicated that auditors may not understand the company and the business as much as they should. My own experience is that we do, in fact, do that because that is such a key part of our entire risk assessment process as auditors. And our responsibilities for the fraud procedures, they don't end at that time. They go throughout the audit. So it is constant. It's not just the fraud brainstorming and planning. It's throughout the audit as the situation might call for, depending on the facts. And if we do become aware of a fraud or a suspected fraud or noncompliance with laws and regulations, of course, we communicate that to the audit committee and to management, and we'd request that they would do an investigation if that was warranted in the circumstances. In those cases, we tailor our audit procedures to the specific facts and circumstances. We consider the severity and the scope of the allegations. We consider the nature of the company, who's involved. We talked about people a lot, that people aspect of fraud in the prior panel. Very important. Is it management? Is it an employee? What's the level that the fraud is perpetrated at? And then as far as the auditor's role, of course, we would not conduct the investigation if there was one, but we do need to look at the sufficiency of the investigation, the scope of the investigation. We need to understand what the company's findings are and conclusions. And then, of course, the remediation is crucial to understand that in what their intentions are, and then evaluate the impacts of all of that on the financial statements and the controls. If we did not think an appropriate investigation was undertaken, if we did not think the remediation was appropriate, we would not issue our audit report. And that certainly has happened in cases where that's necessitated. But despite all of this, all of our rigorous approaches, yes, there is times where fraud is not detected. And for some of the reasons we've already talked about today, it is a reasonable assurance standard, not an absolute assurance standard. And the sophistication of fraud schemes are really just ratcheting up incredibly in the age of technology and otherwise. So I'm going to pause there, and I'm going to come back, I think, later and talk about some of the detailed work we do.
Thank you, Christine. And maybe back to Doug. Doug, I know you've worn a lot of different hats during your career, but I was wondering if you had any additional thoughts about how the different groups are looking at the auditor's responsibilities with respect to fraud. And also, do you see the auditor as a gatekeeper, and how do you see the auditor dealing with red flags when they encounter them?
Yeah, I think the expectation of the regulators and investors going back to the Securities Acts in 1933 and 34 was that the auditor would be a gatekeeper to the public markets and would be providing assurance to investors and potential investors that the financial information that was being used to evaluate securities transactions was in fact reliable information. So the notion of a gatekeeper function is important. Impressing on the entire audit staff that that is their role, and getting them to think more about what it is that investors are expecting and how that relates to the work that they are doing, I think is something that definitely needs improvement all the way up and down the line, including the academic world that I'm in now. The notion of red flags kind of goes different ways. The panel on audit effectiveness, for example, didn't use it because they thought it was used in a pejorative manner. So they said probably better to talk about fraud risk factors, but exactly how that should be evaluated is important. I'm reminded of an older fraud, Home State Savings and Loan and ESM government securities that involved reverse repurchase agreements. And certainly the head of the CEO of Home State was doing the transactions with ESM government securities, which was primarily a big fraud. It was largely fake transactions in repurchase and reverse repurchase agreements. He knew the fraud was going on. He entered those transactions with Home State. The relevance here is that the auditors never had any trouble with dealing with him or had any suspicions about him. But when he tried to do business with Bear Stearns, Bear Stearns would not do business with him. Thought he was what they put it as an oil snake salesman. So while it's very good, going back to Dana Hermanson's presentation, think about the people and so on, definitely that's important to do, but don't rely on it because it's very difficult to do, and auditors have proven to be very poor at identifying the what's often been called that dark personality, the psychopath that is hiding behind a normal face. So those are some of my thoughts at this point.
Thank you, Doug. And then maybe now to, if we could go back to Christine. I know, Christine, you already touched a little bit on this, but I was wondering if as we go further in our panel, you could give us some more insights about how the auditor goes about their work regarding fraud in a risk-based audit. And then maybe also some insights about how firms are helping auditors to identify and assess red flags or fraud risk factors, and then exercise appropriate judgments in dealing with them.
Happy to. So I did discuss previously that the cornerstone of our audit was the robust iterative risk assessment process, which includes a fraud risk assessment process. So the things we do are actually what we have been talking about as far as our responsibilities in the prior panel. So I'll give you an example. The prior panel talked about looking at internal and external sources to get information. Well, we do that. We do read, obviously, analyst reports. We look at the earnings call transcripts and listen to earnings call. We look at industry reports internally. We look at board minutes. We do process walkthroughs. So that's all done. A lot of talk about fraud brainstorming. We do those, and we try and make sure those are partner-led. And I just attended one last week, so I'll give you a real example of that. It was live. It was, and this is a large team that I'm affiliated with, and we all got in one conference room, and we really brainstormed about the key performance indicators. We defined each key performance indicator, and we tied that back to management comp and how they're incentivized, and so how might that be a pressure point. We had a fraud specialist participate as part of that, and it was a robust, rich dialogue. It was not scripted. We were very specific to the company, and we do these brainstorming not just in the planning that was brought up earlier today too, but throughout the whole audit process, if that is, something that is beneficial in that particular case. So again, that's definitely a leading practice to do. It's not just as part of the planning phase. We do tailored fraud inquiries. I participated in one of those actually earlier this week with an audit committee. And we had a really good dialogue as part of that actually ended up discussing things other really than even just fraud. So I think that that's an important tool. We do consider how management bias could impact significant estimates, accounting estimates. And we do look at significant unusual transactions and understand the business purpose. That was also brought up in the earlier panel. And so we are constantly considering as part of our audit procedures how fraud might be perpetrated, how it could be concealed by management, and looking at fraud risk indicators, and really looking at too the attitudes that could perpetuate fraudulent behavior. And we do use fraud specialists. I mentioned that like as part of the brainstorming that we had fraud specialists. And when we use that, that's a facts and circumstances determination currently. And in some cases, the audits do benefit from that specialized knowledge and from assistance from the fraud specialist in determining what audit procedures might be best performed. I would caution, though, against mandating perhaps a fraud specialist participate in every audit, because I think one size, again, may not fit all in that particular case, and it might not be feasible for firms of all size to have a fraud specialist participate. But again, I can't just underemphasize, I guess, when I think about red flags, using professional skepticism. That is a very important takeaway. And the way I think about professional skepticism, though, is that can't necessarily be mandated by a standard. That is a mindset when you think about that, and it's different based on, again, the indicators there. So lots of other things we do, though. We do use technology in thinking about how that might help us monitor companies and alert teams to new fraud risks. The prior panel had the CFRA discussion. We actually look at that. We monitor those reports, our fraud team, and they look for mentions of our clients. And if there is a mention in those reports of a Deloitte audit client, we get that information to our engagement team and help them digest that information and think about, what it might mean to them.
Thank you, Christine. And maybe let's turn to Davis now. And Davis, could you give us some insights into how a regulator would determine whether the auditors had appropriately responded to red flags? And maybe also, are there areas that auditors commonly have problems with?
Sure. I've been doing fraud investigation, financial statement investigations, and evaluations of auditors' responses to fraud for over 35 years. So I've got a lot here, but let me just give you some highlights here. Some of the common areas I see issues where auditors haven't appropriately addressed fraud are in planning in their audit approach. They may only give superficial consideration to the risk of fraud, especially in circumstances where there might be more higher inherent risk of fraud. Auditors also maintaining a belief that management is honest when presented with less than persuasive evidence, especially in circumstances where heightened scrutiny may be required because of indicators of fraud or fraud risk indicators. This can often be driven by timing. Challenges in the audit often arise near the end or are still unresolved as filing deadlines approach. An auditor may feel pressure to complete the audit due to the timing or budget, and they look for the easy fix. Confirmation bias may also be at play here. An auditor may see or focus on the information that confirms their perception that management is honest. I also see circumstances where auditors lack appropriate professional skepticism in situations where there is a more heightened level of skepticism merited. Such as when an entity's ICFR has multiple significant deficiencies, or the entity suddenly has new and significant types of transactions or lines of business, or when there are other potential indicators of red flags. As fraud often results from the exploitation of an entity's control weaknesses, I've seen problems with having only a vague or incomplete understanding of the entity's processes and internal controls, especially in situations where there is no planned reliance on those controls. And regardless of whether there is reliance on controls, not identifying control deficiencies and or designing risk-responsive tests thereto. Further, if additional tests were performed, exceptions in those test performance are not being well addressed. There also tends to be a tendency to freeze the audit approach after the initial planning is complete, not adjusting that approach to address new or elevated fraud risks that are identified in the course of executing on that initial approach. Reliance on controls of the audit is an issue, especially when such reliance is not merited because either the auditor didn't test the design or operating effectiveness of the control, or where control itself was not designed to address the risk for which the auditor is placing reliance on that control. I see issues in performing procedures or addressing issues or anomalies raised in the audit in isolation without consideration of whether there are connections between the issues identified, or by analogy, focusing on the health of the trees and not on the forest. Treating related party transactions as merely a disclosure risk and ignoring the increased fraud risks associated with those transactions is also an issue. For example, not understanding an entity's process to identify, authorize, approve, account for, and disclose relationships and transactions with related parties, not considering this risk in evaluating the entity's identification, accounting, disclosure, et cetera, for related parties, including addressing the accuracy and completeness of the entity's inventory of its own related parties and the related party transactions. Also, not evaluating whether transactions with related parties were timely approved in accordance with the entity's policies, or in the absence of policies, by those with sufficient authority, and any exceptions that may have been granted with respect to those transactions from the policies. And then finally, lacking an understanding of the business purpose of conducting business with the related parties. Also, frauds often occur from management overriding its controls. Regardless of any planned reliance on those controls, I've seen problems with perfunctory performance of the specific procedures required in the standards to address the risk of management override of controls, particularly in the area of significant unusual transactions. For example, auditors may not have an understanding of the controls established to identify, authorize, and approve, and account for and disclose significant unusual transactions at an entity. Dismissing information obtained from the entity and others that may indicate transactions are significant and unusual. Or not considering whether series of associated or similar transactions might in the aggregate represent significant and unusual transactions, even if they individually may not. Also, not considering whether series or associated or similar transactions might in the aggregate represent significant and unusual transactions. Also, for identified transactions that are significant and unusual, performing only a weak analysis of the business purpose of those transactions, or placing blind reliance on management representations. Also, I see issues in only scratching the surface with respect to addressing the other required procedures for management override, including journal entry testing or retrospective reviews of estimates.
Thank you, Davis. And maybe Laura, if we could turn to you, I was wondering if you could give us some insights into about how judges and juries determine whether the auditor did not respond appropriately when fraud has occurred. And also, are there areas where you see auditors commonly having problems? And if you had any thoughts on what could improve the auditor's work with respect to fraud?
So I'll take the second part of your question first, particularly because there was discussion by a few of the panelists about the fraud brainstorming session. What I generally see in discovery is there is fairly robust identification of the fraud risks. Not sure that's necessarily a part of the fraud brainstorming session per se, at least as I've seen them, at least the slides and then the work papers describing what occurred during that session tend to be, in my opinion, pretty perfunctory and repetitive and almost identical from audit to audit. But I do see the auditors identifying the risks pretty robustly and identifying them often as significant risks. Where I think I see the disconnect often, and these are obviously in instances in which we have survived a motion to dismiss and we're in discovery, so we're talking about, you know, a small subset of cases where there might be potential fraud, is that there is a disconnect between the identification of the risk and the procedures that are put into process to make sure that those risks don't materialize. There often is kind of a circular nature to that process where, for example, they'll identify a specific high risk and the control for that will be an internal control kind of mechanism, when also that internal control mechanism is subject to management override and is identified itself as a fraud risk. Or they'll identify something as a significant fraud risk, but then not have the personnel in place to be able to sufficiently take the necessary processes to see whether that fraud has materialized. This is particularly true when you're talking about things that are outside of kind of revenue recognition or standard kind of accounting application issues. Often dealing with really significant transactions for a company or projects for a company that are highly complex and well beyond kind of standard financial accounting, where there's, bookkeeping type of functions that you're concerned about. There doesn't seem to be the level of expertise necessary to understand what's happening or to understand the implications of the information that they are obtaining through their audit evidence. And that to me is where the real disconnect is, as opposed to the identification itself. With regard to the courts, the standard for holding an auditor liable, let alone even getting over the motion to dismiss in a 10b-5 case under the 34 Act is extremely, extremely high. The bar itself for any 10b-5 case is extremely high and has only gotten higher over time. But with regard to auditors in particular, it's an extremely high bar. The standard is essentially no audit at all, which doesn't actually mean you didn't do anything, but it means that your the procedures that you took place and the red flags that you were faced with were so significant that your failure to identify the fraud was really derelict. And I can't speak necessarily to juries, because I think since the PSLRA was passed in 1995, I think we've seen 15, maybe 17 trials, period, in 10b-5 cases. I don't believe any of them involved auditors. We got close in WorldCom with Arthur Anderson, but that case was settled prior to a jury verdict. So I can't speak to juries per se, and quite frankly, I think juries would probably be a little harsher on auditors than the courts might be, or judges might be. But the courts have a really high standard. And to get over that standard at the motion to dismiss stage requires a lot of information. It typically means that there has been some sort of action by the SEC, sometimes the PCAOB, which are unfortunately too rare. It requires a whistleblower. It requires other types of actual documentation to demonstrate information that the auditor had or should have had in the course of its audits. Absent those types of, or perhaps you have a confidential witness who's come forward, but that's even more rare in the auditor world than it is at the company level. Without that, you're not going to survive a motion to dismiss under 10b against an auditor. And as a result of that, we see very few 10b-5 cases brought against auditors. I think this has particularly been the case for the last 10 years as the standard has gotten higher and higher. I know Professor Honingsberg's done some research on this. I think her studies ended in 2016 and saw a real significant fallout even by that time. But I think between 2016 and present, it's very few and far between. I'm currently litigating a case against a Big Four auditor, and I settled one 2 years ago. With the exception of one other case that I am familiar with, I don't think there has been any 10b-5b cases brought against auditors in the last 5 or 6 years. And that's, I guess, not particularly surprising because they're really difficult cases to bring. In fact, in the 2 cases that one I'm bringing now and the one I settled 2 years ago, the initial cases were brought against the issuer and the officers of that company, but were not brought against the auditor. I think largely because they didn't think they would survive a motion to dismiss. So they're just really high stake, high risk cases to bring. And it's really hard to get over that standard that courts require. And it's not typical that we have that kind of information going into the complaint stage. And to the extent any of you are unfamiliar with kind of the litigations process in 10b-5b, unlike virtually every other kind of litigation in this country, there is no discovery permitted in 10b-5b cases prior to surviving a motion to dismiss. So despite having the highest standard of any kind of case you can bring in the United States, you have no access to information prior to bringing the case. So a lot of this is done kind of working with experts, speaking to former employees. Ideally, there is some sort of public information out there that you can base your complaint on. But absent that, the cases are just not brought.
Thank you. And then maybe back to Doug. Doug, in your experience, when auditors did not detect fraud, what went wrong? Did they miss red flags? Did they not respond appropriately to red flags they identified? And do you have any additional thoughts on ways that the standards could be improved?
Okay, all of the above. Starting with some simple things and then moving on to the complex. One simple is the title of the standard, Consideration of Fraud in a Financial Statement Audit. In litigation, I've had auditors say, our responsibility is only to consider fraud, not to detect it. And consider is the lowest level of responsibility in the PCAOB standards. So I certainly get rid of that word. My experience in litigation from the expert witness side is the same as Laura's. It's a very difficult case to bring, very difficult case to prove. There's not any great risk that auditors are going to be held in class action suits to unreasonable expectations by judges and juries. Some of the things I've noted, I want to go to two big cases further apart, quite far apart. One was WorldCom. Arthur Andersen early applied the brainstorming requirement of the auditing standard, which was not in effect at the time, but they had access to it, put it into their audit technology and practice. They actually identified the risk, one of the big risks, an overstatement of fixed assets. But they concluded that the overstatement would result from an interpretation of the accounting standard on capitalization of internal software. It never even occurred to them that fixed assets would be inflated and expenses reduced and thereby inflating income by just entering fake journal entries for assets that were not acquired. And like in many of the cases, the budget for capital additions that year was exceeded by 100% in what was actually capitalized. A more recent case, Colonial Bank, TBW, fraud, $1.5 billion asset on the balance sheet, substantial portion of the equity, almost the entire bank's equity, a transaction that the auditors never understood. The senior on the engagement testified that understanding that transaction was beyond his pay grade. It was unfortunately beyond the pay grade of anyone on the audit. They never understood the transaction at all, which was a what might have been characterized as a third-party reverse repurchase agreement. But the big thing was it involved when issued securities. And nobody in the audit team had a clue about what the documentation of a when issued security would be. The documents that the auditors actually looked at, anyone that had the slightest knowledge about the kind of transaction would have recognized were fake documents. That's another thing about the standards. Collusion and false documents are generally there. They shouldn't be elevated to the level of a limitation on the audit that will prevent the auditor from detecting. It should be something considered in the audit. So those are two cases rather far apart that I think illustrate the kinds of things that often do go wrong. I mentioned just one other area. The certified fraud examiners in their classifications of fraud have two categories very similar to the auditing standard: management fraud, intentional misrepresentations in the financial statement by management, and misappropriation of assets by employees. But they have a corruption category that would pick up the kind of thing that occurred at Wells Fargo that the auditors didn't respond to, and the actual thing that occurred in Colonial Bank and TBW, a third-party fraud, an outside party, TBW, defrauding the bank. But that isn't mentioned in the current PCAOB standard, even though it is recognized in the international standard and the AICPA standard, a fraud by third party. So that's one big hole in the existing standard.
All right, thank you. And I think I want to thank all the panelists. I think you've all given us some really good food for thought. And I think in the interest of time, we have our breakout sessions after lunch. And I just wanted to say, I think our thought for the breakout sessions was we wanted to take a deeper dive into some of the areas that the subcommittee had identified in their presentation, and some of the areas that the panelists have identified. And our hope was that by having the subcommittee do its presentation on what they had compiled from the discussions from the SEIAG previously and the survey, and having these two panel presentations, that the SEIAG would be really have a good opportunity to collect all their thoughts heading into those breakout discussions, and we'll be able to reflect on all of this. And you'll see those questions that we provided for the breakouts will feature many of the themes that the subcommittee identified and many of the themes that the panelists talked about today. So I think with that, if there's any questions. Oh,
can I just ask one question?
Yeah.
Appreciate everybody speaking, and I loved all your comments about the panel on audit effectiveness. One of the recommendations that came out of our work was people referencing the O'Malley report, same report. From your perspective, are there still kind of insights from that document that have never really been kind of put into practice? Would it be something that's worthwhile for the PCAOB to perhaps revisit in terms of doing, if we really want to get more effective audits? I don't know that all those recommendations have really been applied.
Yeah, fantastic question. Answer is yes. When those recommendations were considered by the auditing standards setter, there was still very heavy influence on the standards setter by the threat of litigation and participation by firm legal counsel, not sitting at the table, but indirectly through the ear of the people at the table. So I think a careful examination of those recommendations, further implementation. Something that stands out is that most frauds get started at an interim date. Interim information is not audited in the interim review, and the interim review standard really doesn't dig into what you ought to do in the interim review in relation to fraud detection. That's one of the big ones that's not there, but there are others. I think there's just the sense of procedures directed directly at fraud. I think, the auditors sitting around the table don't probably need any improvement in what they're doing, but there are a lot of other people out there that do. And I think, one question is, ask an auditor, are you responsible for detecting fraud that materially misstates the financial statements? If they don't say yes, with no other nuances, then they don't understand their job.
Thank you so much.
You and I think
Start asking about depositions.
I think that's it, and I think we can now head over to lunch.
Yeah, two announcements. One, the mics remain hot, so please bear that in mind if you're chatting at your seats. And two, Beth Horton, our ethics officer, is going to come to lunch the last 10 minutes in the lunchroom to give you all a brief update, which is required as part of your membership. So thank you, and after lunch you'll go right to your breakout rooms.
Unless you